Okay, welcome everybody to this, I don't know what we called it, I forget. It wasn't really my seminar. It was the Chart Reading Masterclass International Roadshow. Bits and pieces of this were done in Chicago, London, Kuala Lumpur, Malaysia, Singapore, and then Sydney, Australia this year. On this big road show that I did with my friends and partners there, Gavin Holmes and David Weiss and Tom Williams. And it was a lot of fun to do. But when I got back, people here said that, gee, we couldn't go to Australia or Chicago or other places. Could you consider doing a webinar of it? So that's what this is. These are sort of the more of an overview than an overview, but getting into the fundamentals of the Wyckoff method in terms of bar-by-bar analysis, looking at tops and bottoms, some of the classic and fundamental trade setups that are available in Wyckoff that I selected for this, in large part because they also help define structure. And when I teach people how to trade, especially one-on-one, they always come in, it seems, with a lack of understanding of structure and how structure works. And these four trade setups, the spring, the upthrust, the jump across the creek, and then the fall through the ice, really do help you to define structure. And any two of those trades out of the four can make a trading plan for yourself and get you going on that. David Weiss always says if you traded nothing but springs and upthrusts, you could make a pretty good living just doing that. And I agree with him. You really could. So that's what we're going to cover tonight. And then on Sunday, the second half of this is we're going to go into a little more depth in terms of how to apply this, looking at two markets in particular. Both happen to be currency markets, but both are good, helpful markets in illustrating the principles and just staying with the market structure, and then looking for entries and exits within that structure. And when we talk about those markets next time, we'll look at trend lines. We'll look at some of the more finer points of Wyckoff, like shortening of the thrust. And we'll see how the jump across the creek and the springs and the upthrusts and stuff all play out in those markets. You'll see it over and over again. And so once you see it, then you'll see it, hopefully. And then also, of course, the market moves in waves, which is another way of understanding structure and a helpful way of understanding structure. And David Weiss has created this very nice little tool called the Weiss wave. And it's essentially the Wyckoff wave with volume. Wyckoff used to use a kind of he called it a day trading or tape reading chart, which was like a day trading chart, and it was essentially a point and figure chart with volume on it. That's a little hard to construct in today's volume levels. He would look at the ticker tape and mark on his charts by hand, and he could do that. And today, if you tried to do that, you'd be going crazy trying to keep up with all the data. And even computerizing it, we've looked at that a few times, and it's really difficult to do. It's probably not impossible, but it just doesn't make intuitive sense to try to do it that way. And David came up with this pretty clever idea of how to measure volume. Very simple, very, very simple, but very, very powerful. And his wave chart, just like Wyckoff's wave chart, was basically a point and figure chart. And when we get into that tomorrow, Sunday, we'll talk about that, and I'll show you how to then pull all of this stuff together: the Weiss wave, and the Wyckoff principles, bar by bar chart reading, and the four trade setups that we look at, along with applying trend lines in a proper way. and how to pull all this together in a day trading of a week's worth of trading in the Aussie dollar. So I think you'll get a lot out of this. Hopefully you will. People said it was really good in Australia and Singapore and KL. And so with that, let's get going. All right. Let's see. So tonight, what we're going to cover in the first half, and we'll go for about an hour and a half or so. Well, when I finish this, I guess, and hopefully that won't be too long. Just don't get me off on tangents, right? There's a lot of people in here, so I won't be doing as much interaction as I do in, say, deep practice or when I do chart reading mastery. It'd be more of a lecture type of a thing. But I'll try to break that up because I know that especially my voice, can be deadly boring and monotonous. So I'll try to be a bit, interactive as well as I can. But there's a lot of folks in here, so it makes it a little bit difficult to do that. And I want to convey the information in a fairly timely way here. So what we're going to do tonight is we're going to focus on, in the first half, we're going to focus on diagnosing and dissecting charts bar by bar. We'll look at tops or bottoms and tops in particular, because that's what we want to be able to see mostly. And in the process, we'll also talk about continuation. And certainly next Sunday, we'll talk about continuation a bit too. We'll also, in this context, I'm not going to give you trade setups in this segment, but just in general, where to think about initiating trades. And we'll talk a little bit about how to do that. And then as we go along here, I'm going to try to sneak in a little introduction to Wyckoff's wave analysis and just kind of get you oriented, especially people who haven't seen this before. Begin to get you oriented to the idea of thinking in terms of waves as you're looking at the market as a way to help yourself understand what's going on in the market, what I call structure. How is the market moving? Is it making higher highs and higher lows, or is it making lower lows? And the wave analysis can be really helpful in understanding that. And you'll see that tonight, or this morning for some of you, as this unfolds. Okay. All right. So, any questions about what we're going to do in the first half? And then the second half is going to be the 4 fundamental trade setups for Wyckoff. Any questions about that before we get going? And if you do have questions, just pop them in, and I'll see them here. I've got a little question box that I can see, and I may not get right to it as soon as you post it up, but I'll get to it. Don't worry. No question shall go unanswered tonight, which is always the case in anything that I do. When I do a webinar like this, or I do any kind of teaching, my mind is yours. I don't try to hold anything back. I'm happy to tell you everything I know about something. So with that being said, let's get into IWM here. This is a daily chart of IWM. IWM is the exchange traded fund for the Russell 2000 index. Often in the symbology of futures, it might be TF. You might be familiar with that as this futures contract, or as a cash index, RUT. They're all basically the same. Obviously, the cash index and the futures index and the ETF are all different, but they all represent the same market, and they all move almost identically with one another, probably 99% or 98% correlated. So this is the ETF, and it's kind of nice because it acts just like a stock in terms of price and volume action, but it's the whole market, and it's a good one to study, and it's a good one to trade, in fact. So we can see that as we come down here, I'll get my pointer out. I'll try to do it this way to begin with. As we come down to bar 1, we're making, lower. You can see that as the market tries to rally up here, it gets kind of hammered to the upside, meaning that sellers are coming in on any rally, and it drifts down. They try to rally it up, and sellers press it down again, and it drifts down, and now sellers press it down. Not a lot of volume comes out on this. Kind of a little unusual in that regard. And the market starts to respond back to the upside right after that. And we rally up, and it comes down again, just as it has been earlier, as we see earlier. But here, something a little bit different happens on bar number 2, and that is that we dip underneath this previous bar here. I'll just put a check there on that little mark there so you can see it. It dips underneath its previous bar and then rallies up, and we see some volume come in on that, right? This is bar number 2. So it immediately tells us that the odds favor we're going to see a rally of some sort from that. Asta, you may hear my dog Asta barking in the background. He's on guard for the deer. He's on deer alert. They come in and try to make an attack every other night or so, and he keeps them from attacking us. He's very good at that. So when we see something like this, we're even if it's in a downtrend, we're going to anticipate or expect a rally. It may not materialize, but it usually does. And here we do get a rally. But look at the character of this rally in terms of 3 things, really. One is the spread or the range of the price bars. And when I talk about spread or range, what I'm talking about is the difference. Let's say this is a price bar here. And we have a high, we have a low, and we have a close. I never use the open because it really doesn't add much information for me. I'm mostly interested in where the close was, where the high and the low of the day were. So the range is that area between the high and the low. Sometimes we refer to it as the spread of the bar. So you notice that as we're rallying up, the spreads are narrow. They're not large like they were here or here or here or even here. They've now narrowed down. They're 1/2 to 1/3 of the size of those bars. The range of the bar, the spread of the bar, gives us a measure of activity, as does the volume, of course, right? But the range or the spread also is an indication of activity. Here we would imagine that there was a lot of activity on this as the market opens roughly where it closed, rallies all the way up, sellers step in, they rally it all the way down, and then a little bit of buying comes in on the end of the day, maybe the last hour or hour and a half of the trading day that day. But that's a lot of activity. Here on this bar, they opened it, did very little to the upside, did little to the downside, and just pretty much closed it probably right where they opened it, or right around where they opened it. Not lots of activity. And you can certainly see that there's not a lot of activity by the volume on this. It's one of the lower volumes that we've seen in the past week or so, a little more than a week. And so we have light volume on the rally, narrow spread on the rally. And when we get up to bar 3, we come up to the high of the bar before 2, and look at what happens. It peeks its head up above that, and it can't sustain it. The buyers can't sustain those highs, and instead it falls back down to close near its lows. And we see a little increase in volume. That's negativity coming into the market. We had seen supply in the market on this bar just before 2, and we saw that there was pretty good volume on that, so sellers stepped in. Some buying certainly on that. There had to be for all that volume, and then for the market to turn like that. But this point at the high of this bar was a point of supply. It was a point of where sellers came in. They made a stand there. They could have done it up here, or they could have done it down below, but they didn't. They did it right there. And so when we come back up into that area, we're alert to see if sellers will come back into the market. And on bar 3, really bar 3 tells us two things. One is that sellers are going to come back in at that level, or did come back in at that level. And the second thing it tells us, because there's not a lot of volume on it, compare it with bar 2. Look at the volume on bar 2. There was good buying on that bar. On bar 3, not so good buying. The volume is half or less than half. Okay? A market will not push through a resistance level like this very easily on light volume like that. So it's telling us two things: that sellers are still active in that area, the high of that bar before 2, and there are no buyers up there. Buyers are unwilling to chase price up beyond that level. And so the next couple of days we start to see the market fall. The next day it opens, comes down, and buyers make a last stand. But again, look at the volume. It just tells you that that's very unlikely that it's going to rally through that. Very unlikely. And so you'd be ready, if you were a day trader and looking at this market, you'd be ready the next day to look for a short opportunity. Okay? And the market starts coming down. And we start to see volume pick back up on 4, and we come all the way down. I didn't mark this, but this bar is sort of interesting, right? We come underneath the lows of bar number 1 here, just underneath of it, and we rally up, and we do so on good volume. And you would expect some response from that, but we immediately see that the next bar pretty much wipes out all the buying that occurred on that bar. And then we start falling down and down and down to bar number 5 and the bar after 5. So we break down below the lows of 1, and we do so pretty easily. One of the things to notice is the volume here on bar 5 is the largest volume on the chart that we have here in any event, but we don't have all that much data on here. But this is, I don't know, the 17th or 16th, 15th maybe of April, and you can see that we go back at least to the 12th or 10th, 11th here. So it's a good month's worth of data, and suddenly we've got the largest amount of volume on this chart. And we see that we make pretty good progress down. A little bit of buying comes in on the next day, but it's the next bar really that's key in this. And it's just like bar number 2 over here, where we dip underneath the low and we have an intraday spring. We'll talk more about that as we go along. But we dip underneath the low of bar 5 and we pop right up well into the spread or the range of bar 5. So that tells us something important right from there. With the high volume on bar 5 and with this sort of waterfall cascade type plummeting, and then the very next day goes no lower and goes deep into the previous bar there, 5, and closes firm, meaning it closes near or on its highs, and it's right near its highs here. There's only a little bit of selling off at the very end of the day. That combination of things, this kind of plummeting action, the very high volume, the wide spreads coming down, and then the inability of the market to go lower and buyers push in deep into this bar signifies a buying climax, that the downtrend here is most likely over. Okay, or it's either that or we're going to see a pretty good rally or a longer rally. One of those two things are going to happen normally. And if you think about it, if we were to draw a trend line here, I didn't do that, but if we were to draw trend lines in here, and we would draw a parallel roughly here, you can see that this plummeting action, these wide spreads coming in, right down here at the bottom, it's oversold in the trend channel. It's another mark of climactic action. It will typically go beyond the trend channel and go outside of it. That's why we say a market becomes oversold, because it's gone down below the lower trend line. Do I mean a selling? Did I say, Brian, did I say a buying climax? Yeah, I meant a selling climax. Sometimes I get those confused. It's not that I get them confused. It's my mind just is thinking, well, there's buying coming in and here, which there is, and I forget that it's a selling climax. So yeah, the proper term is a selling climax, not a buying climax. Buying climax happens at the height of the market, where everybody comes in to buy. Yeah, and just the story behind this is that, you know, the market's probably been coming down and down and down, and people are holding the IWM, or you know, they're holding this stock. They've got it in their portfolio, and suddenly it starts really zipping down hard, and they can't stand the pain anymore of the losses or of the whatever profits they had in there drying up, and so they want to get rid of it, and they all tend to do it at the same time. It's kind of herd behavior or crowd behavior, and that's what causes the plummeting and the wide spreads and the big volume. And then the smarter money, if you want, or the professional side of the market, the larger operators, would see this as an opportunity to buy this stock cheaply, and they are the ones who stop the market from going down, and they're the ones who have that kind of capital. I'm talking about very large players. They have that kind of capital to be able to go into the market and stop a big cascading waterfall type climax like this. So from here we would expect a rally, and look at the next day. It gaps open. The day 2 days after 5, it gaps up open. Now if this is all selling coming in, would we expect to see the market gap up the next day? Not really, would we? So there's a bit of a vacuum here, meaning that there's very few sellers left, because sellers aren't even trying to press it down all that much. And we pop up, and then we go into this churning action in here, and we started on the day after this gap open, and we're nicely deep into this plummeting action, deep inside of it, right? And that's where you're going to see churning, if it's going to happen, because there's going to be a struggle between sellers who think this is a good opportunity to sell now, and buyers who want to now get a hold of this stock and try to acquire a line, try to accumulate. So we'll see this pumping action up and down, very typical in either accumulation or distribution. And we see bar 6 as kind of an interesting bar. It's sort of unusual, but it's very interesting at the same time. After the gap up day, we come down, and then bar 6, we open up probably down towards the low of yesterday, and we go underneath that low, and we rally up, and boy, it looks like we're going to go straight up to the moon from there. But we stop. Anybody have an idea? Let's just try to do a little interactivity here. Anybody have an idea why bar 6 stops dead in its tracks like that? And then we go back into this churning action instead of continuing to follow through. Anybody have an idea? It goes into the resistance above. Yeah. Buyers are puffed. They're puffed. That's good. Buyers are probably wiped out. You know, they've done a lot of work in here, and so there's you will typically see them start to die out up, towards the top of a trading range like this. But the real key is right here, bar 1. If we were to draw a line across, we're right at that area, right? We're right just above, this had some support here. And now when we come back up to the underside of it, we would anticipate that that would act as some resistance. Okay. Why would I say that? Well, maybe people thought that this was the end of the downtrend here, and they thought price was a really cheap price. It had gone under $60 a share here. So they said, let's buy it. So they bought it, and they're holding long, right? And it's rallying up to 3 here, and they're thinking, boy, I'm pretty smart. I got in here good, and I got in at a low price. I bought the low tick, which is always the amateur's way of approaching the market, right? And then it falls, and they get scared. They get really scared here, and because it plummets down, and you see this selling climax occur. Well, they're holding on all the way through all of this, and when it comes back up here, they are thanking their lucky stars that they could get out at break even or close to break even, so they unload up here. Okay, this is where you will see resistance. Plus, people who understand how to read charts will see this as resistance as well, and anybody who bought in here would know that there's some resistance. They might unload some of their purchase up here, or all of it if they're just trading on the turn. So this would be a natural spot for the market to stop, because traders' behaviors would start to change in here and look to sell. And so we see that. We see sellers come in, although there was still some buying here on the bar between 6 and 7, bar 6.5, I guess, because buyers held it up in the afternoon. And then the next day, they tried to follow through. But what do we see here? What are the two key characteristics of this bar, and what do they tell us? Let me ask you that question. There's no demand there, right? That's right. Why is there no demand? And it is an inside bar. That's right. Narrow spread, low volume. That's right. Narrow spread, remember I said before that the narrow spread means lack of activity? And the low volume is another measure of that. Look at this. This is the lowest volume we see in a couple of weeks. So it tells us immediately that buyers are either tired out or not interested in going higher than that. If we were watching this and we were playing this for a small swing or for intraday trading, if we were close to the market tomorrow, we would be very keen on watching this, and this does a perfect thing. I look for this all the time. We'll see some more of this on Sunday night, but I would mark the high and I'd mark the low of this, but I'm very interested in the high. And the market goes up above it, can't hold it, the buyers can't hold it, and starts coming down. And that's where I would short. That's where I would want to be going short. As it's coming back down through yesterday's high, maybe if it already came down through and then goes back up and tests it with no demand type of action, which we'll see more of as we go on. It's a perfect spot to go short. It's a perfect spot to go short. It's an upthrust, if you will, of yesterday's high. That's one of the things that I really love to see. And then I'm looking to see what it's going to do when it hits the low of the day from yesterday, and then I'm watching the 2-day low in here. So that was a very nice trend day to the downside, and we see volume pick up a little bit, and that tells us immediately that we're going to see this market come back down and at least retest the lows here down at 5. And they do. And in fact, they go underneath at bar 9. And we see that, and it closes on its low, which would make, it would make you think that the market's going to go down lower. The key here, and it's not easy to read this real time, But the key is that there was an awful lot of buying that went on in here, and there's a lot of volume in here now, and this volume is not the same level as we saw coming down on on this bar and on this bar. As they broke underneath 1, we see this kind of volume and we see this kind of volume. Now as we break underneath 5, we see about half of that volume. Right? So doesn't mean you would jump in and buy on the low of 9. That would be kind of crazy to do. But you would be noting that. You're saying, boy, we're breaking down below the lows here of 5, and we're doing it on lower volume. And I wonder if this is going to really continue to go down. So again, if you're close to the market and you're watching this the next day, you'd be very keen on what happens on the trading. And it's almost on a bar like this in particular, you will almost always see trading around yesterday's low. It just is natural for the market to do that. They might have brought it down overnight and then they come back up, test it before they come down lower. But in this case, they dip underneath and they start to rally it up and they hold yesterday's low. Now, if they're going to hold yesterday's low, then this thing is probably going to go up above the low of 5, which it does. But I'm talking if you were watching this as an intraday trader, you would anticipate, if it holds the low of 9, you would anticipate it breaking through 5. And we would have what's called a spring setup, which we'll talk about in another hour or so. This is a choice trade setup right in here. This is a very, very good spot to go long. And look at the volume. It's even bigger than what we saw on bar 5. And what this is, Bob Evans used to call this volume off the bottom, meaning that it dipped down, the last of the sellers got covered their shorts, or the last of the longs sold, and now the shorts start covering, and everybody sees that the market's not going to go lower, and we start seeing buying come in, aggressive, strong buying, and so we see that volume off the bottom. It's a very bullish indication. Plus, it's a nice spring. All right. Yes, Fiona's not able to log in. I'm not sure. She was in before. She should just be able to log in on that. Helen's not here, and I don't really want to take the 10 minutes out. I'll when we take a break, I'll try to contact her, but not right now. I'm surprised she can't get in. Brian says, would I be a little concerned that the heavy volume after bar 9 comes on the up bar, suggesting supply is still present? No, not at all. Not in this situation. If we were up high, if we were up here and I saw that heavy volume coming in like this, we'll see that in a couple of charts in a minute. Oh yeah. But when we've got this kind of a thing going on where we're on a low and there's good volume coming in, that's, Wyckoff said that good volume on good spreads moving up is bullish behavior. It's not bearish behavior. So no, I wouldn't be concerned about that at all. Now, I want to point out something else. I know we don't have a lot of volume on, a lot of data on here, but if you go and look on any chart where there's a turn, you will see this. If I block this volume out here, like this, and let's say we were to take an average, and if we even included these, if we took an average in here, it's probably somewhere along here, or maybe a little bit lower than that, right? This is something you need to train your eye to do. Look at all the volume here. If I block that out preceding this, and if I did that average, it's probably in here somewhere, maybe slightly higher, I don't know. All right? Well, we made that kind of movement on all of this volume here, how come we don't go any lower on all of this volume here? Okay. And I'm asking that sort of rhetorically, but the point is this, that if you can start to identify these blocks of volume like this, where the market stays in this kind of trading range, and we can expand that out, in fact, and go like this, and do this here, and we'd say, well, maybe it's a little bit lower in here, but that's the average, and compare this to this, you can see now that this is accumulation in here. This is a hallmark of accumulation right here, where we see this volume increase and the market is trading sideways and not going up and refusing to go down after we've been in a downtrend. Okay? After we've been in a downtrend. So this big pickup in volume, you want to be able to start training your eye to see that. It's very important. And all you need to do is just block it out and kind of be aware that this kind of volume will come in on a bottom. So if you see this market not going anywhere, it's broken the downtrend line here, and so on and so forth, put your eyes down on the bottom of the chart and take a look at that volume. And if it blocks out like this, you know you've probably got some accumulation going on. So we rally off, and notice here, notice this, it just kind of, as David Weiss would say, it levitates up without much volume. And that's fine. That's no big deal. It's not no demand at all. It's not no demand in here at all because of the context. We've got some climactic action over here. We have this big volume. We got volume off the bottom, and we have a spring. So all of that combined is nice, and it's not going to be negated by a little bit of light volume coming up. Well, we come up into B, and we see the volume pick up again, and look at the close on this bar. It's closing down below here, and that's because we're back into this same area, right? This same basic area here, where we had some resistance, we had some support. It's now turned into resistance. There's still going to be a little residual resistance there, and that's why the market rolls over here and starts coming down. And on C, look at what we have here. Look at the low volume. It tries to go up, and it's similar to 6 in a way, the bar 6. But this is on much lower volume. It's about the same level of volume as on 7, right, when we had that no demand. So that's a nice example of no demand, and then the market starts falling off after that. And on D, look at how we start to slip down, and we go way low below this low here, and we see the volume pick up gradually. That's really supply coming in, and it's not demand coming in. Okay, that's really indication that there's still a fair amount of selling. And the next day on E, the market rallies up above the high of the previous bar and then comes down and closes below bar D. That's pretty negative. We don't see a big pickup in volume, though. It's sustained for sure, but it's not an increase, a big increase in volume. And on F, this is very interesting bar. This is an unusual kind of a test, but it's a test nevertheless, where we dip down. Now we're coming back into this area in here, right? This high volume area where we saw high volume on A, high volume on 5, and then look at F. It's about half of these guys, of these two volumes here. So this is a test. It's saying that there's no more supply at this level, and we know it's a test in part because of the volume and in part because of the close. I would have liked to have seen the close up here on the high or right near the high. That would have made me a happier camper. But you don't always get what makes you happy in trading. So you'd be aware of this, and the next day, this is a great spot to be looking to make a buy opportunity. You want to see the market start to rally. If you're close to the market intraday, you can buy on a small intraday 15 or 30-minute pullback. If you're not close to the market and you see something like this, you can put a buy stop in, or you wait till the next day for full confirmation, you buy this on the close. And then we get a push up from here, and now we finally break on this bar. I didn't mark it, but we finally break this level here. And as we often do, when we come back on these couple of bars here, I labeled them both H. These are little test bars. Very good spots in here to go long, to be buying in one of these because of all of this strength in the background. Okay. Would I consider F as a shakeout? Maybe a little bit of a shakeout, yeah. More of a test, though, I think, on high volume. That'd be what I would call a high volume test. And I think Tom Williams would call it that as well. So is the activity prior to the high volume bar accumulation or not? Which high volume? This one here. It's the beginning of it for sure, yeah. It starts with the climactic action, and then we would see this, Wyckoff would have called this a terminal shakeout. We tend to call it a spring these days. And then it dips back in, but this is all accumulation in here, all of this. Okay, good. All right, so can I repeat the entry at G? Well, yeah. It depends on what you're doing here. If you're close to the market and you see this starting to rally on G, then you want to just buy it because you know you've been in this location and we're not going down. Now we're starting to rally up. If you're end of day trader, you can either buy stop F, or you can wait until and buy on the close, or buy the market on the open the next day. Anywhere in here is fine, really. Anywhere after F or beyond is fine. You'd see some pretty good movement in the afternoon here on F if you were close to the market. All right. That's good. Any other questions on this? And I'll move us on then. Okay. Bar G and volume G, not the same day? I think they are. I was pretty careful when I put this together. I'm not going to go through and count it now. But G is this line here. It's this volume here. I'm pretty sure it is. Okay, let's go on then to BHP. Here's a little bit of a top, and then we'll go and do a little bit of this bottom here as well. But just look at this chart. Just taking a look at this chart. Do you notice? You see this big block of volume coming in compared to all of this over here, right? And you see this volume coming in here at the high. Compare that to all this over here, right? Start to look for this stuff. It'll start to jump out for you, and you'll start to see it pretty well. Okay, so here's like a naked chart of BHP. This is an Australian stock. It's a big mining stock. It's one of their largest probably one of the largest mining companies in the world. And it's a nice stock to watch and trade. This is the New York Stock Exchange version of this stock. So it's what they call an ADR, and I forget exactly what ADR stands for, but it's like a foreign company being traded on the New York Stock Exchange. All right, let's take this chart and look at it a little bit. We're moving up here. American Depository Receipt. Thank you, Brian. Thanks. Appreciate that. So we're moving up here, and we've got a high and higher high, and a higher low rather, and another high. But notice this. We pull down here, and we start to see some volume. I didn't mark this, but we see a little bit of volume coming into the downside, where it is not expected to do so, and we get a bigger swing down. I'll talk about swings in the next chart or two. Or just we'll just do this one easy. Just suffice to say, we rally back up to here, up to the bar before 1, and we anticipate that this market is going to push higher, but it doesn't do that. It turns around here at 1. We also would anticipate a little more volume coming in as we drive up, right? As we push higher, we would expect more volume to come in. That's a little subtle, that's a little hard to see, but it certainly isn't hard to see that we drop back down underneath, and we don't just go back and test this level and hang around here a little bit and then start moving off. We don't do that. We go underneath, and we go underneath of it well. And then what happens at 2? Look at the volume here on 2 is much lighter, and we see that telltale kind of, they buy it up in the morning, and then sellers came in the afternoon and close it low, right? And it's right at this level. This is an up thrust followed by a test of the up thrust, and it's on a weekly basis. That's a very serious thing on a weekly basis. It's going to take the market down, and it does. This market goes from around 90 down to somewhere around 30, a good significant drop down. Okay, and we come down to 3, and I just put little arrows here to show that as we try to move down, each time we move down, the volume picks up here, okay, or is sustained. It's pretty good volume coming down. So anytime it tries to rally, it only gets a bar or 2 at the most here, 3 at the most. Anytime it tries to rally, the rally fails. And we come down to 3, and we get big volume coming in here, and you can see that it dipped underneath this low here, and it's closing nice and firm. So the anticipation there is that maybe we're going to try to spring this and hold this level and try to rally back up. But look at what happens on 4. Just no ability to rally. We drew the downtrend line from 1 and a couple of bars after 2. It comes right up to that and then fails. The sellers come in, and there's good spread there. Not huge volume, but certainly, I mean, it's less volume than the last couple, but certainly not really light volume. Okay, it's pretty average volume, and the spread is telling us that this is just negativity coming back into the market, and that this buying that occurs here on 3 is in trouble, potentially in trouble. And then the next day we gap down, and the volume starts to pick up again, and obviously that spring has failed. Okay, that spring did not work out, and that's not too much of a surprise. As we're coming down, we're seeing no ability to rally this market at all, none whatsoever. Typically you'll see a little bit of rally anyway, but we don't see it here. Anyway, so we come down. What do you all notice on the bar before 5, 5 itself, and then 6? What might give us a clue that this is going to try to turn around as it does on, I guess, 7 and 8 here? Anybody? Yeah, some shortening of the thrust. People in my other classes know this. As the market's coming down, notice that we've got pretty good volume. You can see the volume here on the red arrow. That's this bar before 5. You can see 5 is still pretty strong volume. And then 6 is even bigger volume, right? So we've got 3 bars here, 3 days, or 3 weeks rather, excuse me, 3 weeks of pretty good volume. Second only to this weekly bar, this bar number 3 here. So we know that that's very high volume. And look at the progress being made down. It's not very stellar, is it? We're making just very little progress from this bar to 5 and then to 6. We're still making lower lows and lower highs on the price bars and lower closes, so it's still negative. It's hard to pick this as a bottom, but we would be aware of this. We'd be alert to the potential of the market trying to turn around this area, because it's so hard to push the market down despite the high volume. Okay? That's shortening of the thrust in here, which is very difficult to push that market down. It pops up. We go up to 8. That's the top of these two bars where we're going to find a natural shelf of resistance, right? Especially since this bar, bar number 5, opened, rallied up, and then came back down to close here. We know that there's a supply line level in here, and that's what bar 8 runs into, and it's doing so on relatively or comparatively light volume. It's not a real lack of demand, but you know, relative lack of demand here. And then we dip underneath. We come back down and we dip underneath 9, right? Which is just, I'm sorry, at bar 9 we dip underneath 5 and 6, and then hold above that, and we see that volume off the bottom here at A again, a good push up. The next bar is an inside bar, narrow spread. It's down bar, closing, in other words, the close is lower than bar A, but it's on relatively light volume, and it's inside, so that's a nice little test in here, comparing this volume with these volumes over here. It's testing not just this bar, but this whole area in here to see if there's any supply left, and it's not finding any, or if there is, it's being bought up because they're not allowing it to go down. Yeah, it's a no supply bar. That's right. It would be. Yeah, Tom and the VSA folks differentiate between no supply and tests. I personally, I don't do that. I just see this as they're coming down and they're testing in here. There's no supply in here. To me, it's pretty much the same thing. That allows the market to rally up to B. And we have no, we're back up into this area here. I'll put the line in, back up into this area where we saw supply here and lack of demand at 8. And at B, it's having difficulty. It does struggle and goes up above, but at C, we've got kind of a double whammy here. We've got the downtrend line, and we also have this horizontal line. And it's going to be hard to push through that, and so it comes back down. But there's not a lot of supply down here at D. We got narrow spread, lighter volume, and we're back still in this area. It's just this general area in here where there's some potential accumulation going on. We don't know it. Well, we can surmise it because of the block of volume in here and because of all this activity. But we don't, it's not over yet, right? This is not a spot to buy here. We rally up to E, we come back to that same line, but this time we're seeing bigger volume coming in, and then it stops. And then look at this. We come back down here to G, which is this volume here, and I'm sorry, this volume here, just very low volume, and then we have a little spring under here. This now, for the first time, is a good spot to buy in this whole range. This is where you could place your bet. Why? Because we've broken the downtrend line decisively enough, and we've been playing around in this area, this supply, this zone in here, which is now becoming apparent that it's an accumulation zone. And this is one of those high volume type tests as well. And then it rallies up through here, breaks above that line, and then all these little eyes here are little tests, all these little bars in here, and also a good spot to make a long trade. So the 3 locations here would be a short around 2, and then a long in here and over in here somewhere, in one of those bars. Okay, I gotta dismiss Fiona from the list of attendees so she can get back in again. I will be happy to do that. If I can find her now. Where is she? How come you're not here, Fiona? It's alphabetical. I don't have her in here. I don't quite understand. How to deal with that, but I'll try one quick thing here. Let's see. I'll try to send her a quick email. And she'll get a new invite in here, a new link to go in. Okay, I just sent it to her. So she should have a new link there. Okay? All right. Okay. So that's BP. Any questions on that? As I say, H, and I'd like this I here would be one that I'd be interested in buying. This bar right here, this I, but actually any of them are fine. And then also, as on this bar, as this is rallying up, there's a nice spot to go long too. And then this in here for short, right here at 2. Why suddenly less activity on the bar after B? No special reason. It's the holiday season here, the last week of the year and the first week of the new year. I would imagine that has something to do with it. It's usually very light volume around then, so I would see that occurring. All right, let's shift gears here and look at a futures market. This is the Aussie dollar on a daily basis. And again, it's always helpful to draw in some lines. It helps to frame the market out. When you're just looking at a naked chart, the first thing you want to do is to say, okay, where can I draw some lines in here? Where can I start to make some structure out of this? Where can I identify some structure? So you can see this market likes to shake out a bit. We rally up here, we're making new highs up above these levels at 1, and we come down here to 2. Volume dries up a little bit, or recedes. I shouldn't say it dries up. The volume recedes underneath 2. Look at 3. If I went long here and I saw 3, I would not be happy about that, because I would anticipate that this would be coming through. But it doesn't. This is what David would call, or very close to, a resurrection bar. There's a better example on this chart, but it's one where you expect the market to fall down, and this is kind of a little different look than what you would normally expect as a shakeout, but it is a shakeout nevertheless, because of the volume and the price action. And then the very next day on bar 4 it rallies up, and it does so on good volume. We come up to 5. Look at the volume here on 5, and then look at the spread. The spread narrows down and the volume stays high. Anybody have an idea what's happening on that bar? We have high volume. We get basically a flat close. In other words, the close is the same more or less as the previous day, and the spread is narrow. There's some selling, right? Yeah, there's selling coming in. People are buying it, no question about it, because all of that volume. But it's almost as if somebody is saying, okay, you want to buy it, I'll take it. And they're selling into the buying, and they're keeping the market from going higher. It's capping the market. If this were very high volume and it were, into good new high ground, you would call this the end of a rising market. But it still indicates that there's some supply there. There's still some supply coming in, right? that they've capped it here. And you can also see that there's not much progress being made as we go up. And in fact, volume's falling off a little bit on these couple of bars. So supply does come in, and we see this coming down. But notice that as we come down, what happens to volume? It gets less, right? So supply is not ready to exert its control yet. At 7, we go underneath the support at 6 and immediately turn around on 8. This is another one of those shakeouts. Volume picks up here, we dip down underneath, but then immediately it comes back up above. It doesn't even go below 7, the low of 7, but it goes back up above that level at 6. And you know, it confirms it really that it is a shakeout, that there really wasn't selling there. So is 7 stopping volume? You could consider it that way. Yeah, I think it's more that they're getting rid of weak longs to some degree, and they're coming back into this bar here where everybody got, you know, all this volume is in here, and it was a big day up, big upside day, so in this market. And so people are long from in here, and the professionals know that, and it gets shaken out a little bit to scare these weak longs out to grab their contracts because they know that the market is strong. I mean, that's the explanation behind that kind of a move. It's typically what happens, what they do. Anyway, we rally up and we come up to 9, and then now we could have, you know, we would create this trend line in here from 1 and 5, and now at 9 it respects it, comes back down. What do you notice on the move down to A here? What do you notice on the move down to A that we haven't seen before? Yeah, higher volume coming into the downside. Each time we've dipped down here and here and here, volume has receded. This is the first time, look at, we've got volume increasing to the downside as we come down. Does that mean that we go short down there? No, it's you want to piece some of this stuff together and begin to think about you know, telling yourself a story. We'll talk more about that on Sunday, about how to piece together a story of supply or demand. But this is a key thing for you to be aware of, that reactions in an uptrend should come in on receding, lighter volume. When they don't, and we've got an increase in volume, that's typically a change in behavior, what we would call a change in behavior, a change in the normal way that an uptrend works. And now we want to be, aware of that and thinking about getting out of any long positions we might have, and thinking about looking for a short opportunity, potentially, okay? With the low, question here, with the low of 7, breaking the high of 3, is that a concern? No, not at all. Nope. No, not a concern at all. Nothing. I wouldn't have even noticed that, to tell you the truth. So what happens here on bar B? This is, this is one of those resurrection bars where it goes underneath and then rallies up. Tom calls them a bottom reversal, 2-bar bottom reversal. The first bar is down, the second bar goes underneath and closes. You can just buy this on the close here, even though it's a, you would have liked to have gotten in lower. Something like this is very bullish, and we would anticipate this market pushing up, which it does. And then we come up now, we're along this trend line here, and look at C, look at bar C. Pretty much the biggest volume on the chart, I think, right? And it's a down bar. We've not seen that before, have we really, in this? We've seen We've seen big volume going up on 4. We've seen some capping on 5. This is the first time we've actually seen a down bar occur on that high volume. Also very significant, and very significant where it's happening. So we have kind of 3 things going on here that's telling us that this market is beginning to get old in the tooth, so to speak, that the uptrend is very mature. The first is the increase in volume to the downside for the first time. The second is that we are butting up against our trend line, and we've got 3 touch points on this, which is pretty good for a trend line. And then the third is that we see the biggest volume coming in on a down bar that we've seen in this whole move up. So there's supply coming in at the right spot, and the market has been in an uptrend, so we're looking for it to die out, and it starts to die out here at D and again at E. Both are okay spots for a trade to the short side. It's just we're seeing now, after this move up, there's no demand left up there because of the relatively light volume. And then the market starts moving down, and another nice trade is right here at F. It's what we call a hidden up thrust, where the market tries to push up above the recent highs and then closes down below that and closes on its low. And you can see that there's good volume coming in, which indicates that we're going to go down lower. And this comes in after all of this other stuff, the increase in volume here, the lack of demand up here, and the respecting of the trend line, and then coming off of that. So is C a buying climax? No, I wouldn't call that a buying climax. It's just supply coming in, Terry. Just supply coming in. Just supply coming in. How are we doing on time? Oh, I'm already going over, aren't I? Yep, okay. So let's keep going here. Here's, what's this? Panasonic Corporation. This is kind of an interesting chart. This is a monthly chart. We're going to do some multiple time frame stuff in here with this. But we see at bar 1, let me get this. At bar 1, we see big supply come in, right? It's kind of the reverse of the bottom reversal. This is what we call a top reversal. The market's going up, and then it goes above the high of the previous bar and comes crashing down and on good volume. That's real supply there, okay? Real supply. Market tries to hold in here, and it goes sideways a little bit. We dip underneath the low, and we spring off of that. And that's nice, but look at the rally up. Look at the character of this rally up. Compare that with, up here. It was easy to move the market up. We had good movement up in some of these bars here. Look at bar 3. Big volume. And it's supply coming in. They try to rally it up, and it closes right there in the middle. Right? There's just not that much. And then up here on bar 4, be hard to tell that this would be a good spot to go short, but on bar 4, we're seeing less volume coming in, less demand to the upside, and the market comes off. And it's doing that because it's back in this supply area over here. It's analogous to the test that we had at F on the, forget if it was the IWM chart. The only difficulty is we don't have stuff going on in between to tell us that the upside is over. So therefore it makes this difficult to trade. You might, since this is a monthly chart, right? This is a monthly chart. You might have a line drawn across here, and as it comes down through, then on the weekly or on the daily, you would see some no demand in here on the smaller time frame charts. which would give you a good opportunity to go short. Okay, but just looking off of the monthly, it's kind of hard to do that here. Is that close enough to be considered a double top? I guess. I don't really think about double tops, to tell you the truth. It's testing this supply over here is what it's doing, and finding that there's just no ability to rally any higher. And so we start coming down, and we come and we break down through, and look at bar 5. It closes kind of, you know, you would think that, oh, buyers stepped in, and they did. But boy, that's weakness, coming down this far below the support level of 2 here. And then the next day tries to rally up, can't get up above the low of 2, and then comes down. Okay, now everybody should have this. What's going on here? What's going on here with these price bars from 5 to 7? Yeah, shortening of the thrust, right? We saw that earlier. Same stuff comes up all the time, just in different ways and, you know, different flavors, so to speak. We see some volume coming in here at 7, holding this market up. It's kind of the opposite of what we saw where we were capping the market and in the Aussie dollar at the highs. Here we're holding the market up, a little bit of what sometimes some people will call this bag holding. We rally up. We start off good, but notice what happens. We see this over and over again, don't we? This where we had some support here, and now we come back up to that level. We've seen it several times so far. It's the same thing here. All right, now this is a monthly chart, right? Get in your mind here 8, 9, and A, and then X. 8, 9, A, and X, because I'm going to shift over. This is now a weekly chart. 8, 9, A, and X. Okay. So I'll go back a second. Here on the monthly, it's certainly readable. We've got shortening of the thrust coming in here as well, but it helps when we go down into a smaller time frame. And now look at what we've got. We rally up, we can't go higher, and then we start coming down. If we were looking on a daily chart, we'd see it even more clearly. We're coming down, we make this big move down here, and now look at the light volume on this rally. This is a test of the upthrust. It's testing the upthrust. And we're seeing no demand on that test. Perfect spot to go short. Perfect spot to go short. So that's one little instance of how to use, and we're going to go through more of those. One instance of how to think about using multiple time frames. And now I just want to give you a kind of a quick basic introduction using this chart to think about wave structure. We might be looking at this. Sorry, I'm jumping around. It's sometimes hard to do this. We might be looking at bar 5 here, right? And say, wow, boy, there's a big volume in here, and there's a lot of, it closes firm. Why isn't that buying in there? How come that's not buying? Well, this is the reason right here. When we think about waves, what we're looking at is here we had the up wave was large, and then we have a down wave, and the up wave shortened here, and now suddenly the down wave got larger than the last up wave and even the last down wave. Okay, so the way we're going to talk more about wave structure on Sunday, but this is just, you can just sort of see this, that sellers are dominant here. The down wave is much larger than the last up wave, and now as we come into resistance, this up wave is fairly is relatively small compared to this last down wave here too. And then look at the volume coming in. Okay. Can I give you the settings for point and figure charts to use with Wyckoff waves? Harvey, I'll talk a little bit about that when I talk about the Weiss wave. Okay, on Sunday I'll talk about that a little bit, and I'll give you some of the settings for that. Okay, here's NVIDIA. This is kind of an interesting chart. I like this chart. When we look here, first thing that should be jumping out, two things should be jumping out at you. Well, first, we're in an uptrend, right? We know that. We're making higher highs, higher low, higher high, higher low, higher high. Okay. Notice as we are making these highs, what kind of progress are we making? We make a lot of progress here, a little bit more to 3, and a little bit more to 5. If we were, I'll show you a graphic that I use in my trading that I always find helpful. If I were to put this on and I were to just mark these highs here and mark them here, you can see I made a lot of progress here and I'm having a struggle up here. Okay? This is just another form of shortening of the thrust. This is now shortening of the thrust on the swings or the waves. Okay? It's just another form of it. So that's one thing that should jump out at you. The other thing that should jump out at you is that as we're going up, volume is going down. That's never good for a bullish move. Okay, markets certainly can go up on light volume. We saw that all summer, right, in the S&Ps. But you know, this is in the prime time of trading here in January and early February. You shouldn't be seeing that. Okay. Now, so we see that shortening of the thrust in the waves, and we see it market moving up, and the volume on each push, each drive up is getting less and less. Now, when we look at this, though, I see here roughly 1, 2, 3, 4, 5 days in the week, and I would draw a line like that. And I would say, boy, we've gone sideways for a week, and we really haven't pulled back at all. And I also notice that as we're coming back here, we are seeing volume drying up. So that's a nice little spring to buy right there. Okay. Same thing sort of happens here on 3 and 4. We kind of go sideways, and we're not really making any big low down, right? And volume certainly doesn't expand on to the upside here, to the downside. And it's just, and it really is, it's just holding gains and going sideways. Now, let's go forward a little bit. What happens on the reaction down to 6? Let me ask you, what do you notice on this reaction here to 6? What do you notice on the reaction down to 6? Volume picks up, right? Yeah, good, Darren. Volume picks up. It's the first time we see that. Before, it doesn't pick up at all, right? And it's making a bigger, it's easier to go down. Suddenly, we're not just holding sideways here, we're going down, right? So the length of the wave increases. And that's a change in behavior. That's right. That's right. So if we were to look at the waves here, it's another way of, this is another way to think about shortening of the thrust. And another way to look at waves. You can see the wave here, nice and strong. The down wave is small. Up wave is still, it's gotten smaller, but we don't know anything about what's going to happen yet. Down wave is still pretty small. Up wave, getting smaller than the last wave. That's not necessarily good. And then look at what happens. A big down wave occurs. This is a change in behavior. We get this little parabolic move up to 7. Here we pull back to 8, and look at what happens at 9. The light volume occurs here, and that's a nice trade right in there. Right in there. It's a very nice trade using this wave. And you can see that the down waves now have gotten larger than the up waves. and the last up wave is small. We'll see a lot of examples of this on Sunday when I go through using the Weiss wave on the Australian dollar. But you can see that you can begin to now start to pick up a few things here. When we're in an uptrend, we want to see the pullbacks come in on smaller spreads and not have much of a pullback, and the volume recedes. When it changes, that's telling us in advance that the market is now starting to see supply come in. When we see a big downside bar with big volume, that's telling us that supply is coming in, especially if we haven't seen that before. And then when the waves start to change and we start maybe seeing shortening of the thrust, it's harder to move the market up, and so things are starting to change for this market. And that's not this is typical stuff out of the Wyckoff playbook, just how to read the market by its own action. All right, good. Let's now we're almost down to the point where we want to take a 10-minute break or so. Let's take a look at a market here, and let's look at what do you notice about bar 1? What's happening here? And just as context, obviously we're in an uptrend here, right? We're in a nice uptrend that's going up. What do we notice about bar number 1? We notice supply. Yeah, we notice supply. Have we seen the spread of this bar is pretty good size, right? Have we seen anything equivalent to this since the uptrend began, which it started here? So let's just take a quick look. Well, here's a down bar. Pretty good spread. No, not as big as that, right? Almost, but not quite. No, no. So this is the biggest down bar. And look at the volume. Since we began this uptrend, which is on this bar here, biggest volume occurred as volume off the bottom. We talked about that earlier, right? We see that coming in. We see some volume here, but it's about half the size, or maybe 60% of the size of bar 1. So this is think about this for a second. This is a mature trend. We've been going on. There's no time here on this. I think it's a daily chart. Yes, it is a daily chart. But this is probably a couple of months worth of bars of trend. So it's been going on for quite a while, and now suddenly we have this large volume here. Okay. As we rally up to 3, look at what happens. Lack of demand up there on the rally. Okay. We don't have really pullbacks in here, so not quite so easy to compare this with prior pullbacks. But the last bar here, 4, tries to rally up and closes back inside the range of bar 3, and it does so on a pickup in volume. What do you think that is? Is that buying or is that selling coming in? It has to be selling, right? Because if it were buying and the volume picks up, we would expect, if it were all buying, we would expect that bar to close on its high or probably even bigger, right? But it doesn't. It closes in the middle, so it has to be selling coming in. So let's advance this a little bit further. So the market dips down here underneath the lows of 3 and 4, finds some support and rallies up, and does so on pretty good volume. Okay, all right, maybe we're going to go higher. But look at bar 7. What happens there? It's one of those no demands where it rallies up above the high of the previous bar, finds no more demand there, and starts to roll over. Also, the spread is narrow, right? The spread is narrow. If we see good volume like this to the upside coming in, and then we get to the upside, and the spread becomes narrow and the volume becomes light, it means one thing and one thing only. There's no buyers up there. There are no buyers up there. So my mentor, David Weiss, went short here on this day. Let's see what happens here. What do you see on bar 8? What's happening there? It's selling, right? But looking at it from a bar by bar perspective, we've got wide range, right, Marat? Exactly. We've got wide range. Look at the volume. It's as big as we saw on bar 1. And look, this spread's even larger, and it's to the downside. That's selling coming in, okay? We rally up to A. And not quite a markdown yet, Darren. Markdown would be after distribution has occurred. But what we see here is a markup to A, and what happens as we, not markup, a run up to A, and what happens on the run up? Volume diminishes. Okay? So let's go a couple more bars here. What happens on B? It's another down bar, high volume. On bar C, they try to rally it up. It's an inside bar, very light volume. Okay? Now, as a trader, I'm keenly interested in this market to the short side. Why? Because I see a change in behavior on 1. For the first time, I see big volume coming into the downside. Lack of demand on the rally up to 4. Lack of demand on the rally up to 7. Big volume coming into the downside. Lack of demand on the rally to A. Big volume coming into the downside. And now lack of demand again on the rally up. So now I'm ready to take a short in here. Okay? And now I've got an inside day, which tells me that odds favor we're going to see some movement occur in the next day or two. Okay, everybody see this? Yeah, this is, Terry says, distribution. Absolutely, this is distribution occurring in here. This is the hallmark of distribution. It's not always this clean. I wish it were this clean and clear cut. This is a nice example of it, but this is what you look for in distribution when you're at when you're mature in the trend. In other words, you've been in a trend for a while, and then it starts doing this churning action, this pumping action, and you see bigger volume coming in. That's being sold down here. Okay, it's being sold. So let's see what happens here. This market starts coming down at D, and volume comes in again to the downside, and then wham, look at F. Huge volume. Anybody have an idea of what this was, what this market was? Some of you know, but I know you know, but others may not know what this is. Abdul says flash crash with a question mark. Exactly right. Exactly right. This is this F is May 6th, 2010, when we had that so-called flash crash. Okay? Now, as I said this in the seminars that I did all over the world this year, we couldn't predict that this was going to happen, that we would go down to F, and it actually goes a little bit lower than this. We couldn't predict this, right? But we certainly could read the supply in the market ahead of time, ahead of this. We certainly could do that. Did David hold or sell? David got out, I think, down in here somewhere. He was out fairly quickly. It became more evident that was going to go here, and I had a student short in here, and then I shorted down here. And I took it off the day of the morning of the flash crash, believe it or not. It was a nice trade. I thought it was getting climactic then, And little did I know, what do I know? So then we rally up, and look at the rally up. What happens? Look at the volume recede. K, picture perfect trade in here. Picture perfect trade. And if you think about the wave structure, look at this big wave down. Right? My goodness, that's huge. So that's a nice trade, and then it does go down and retest this low way back here in February. And then just notice that the volume now is picking up dramatically in this area. I boxed this area in here, but really it's all in here. And compare that with all of this, right? And you can, well, we don't have the data beforehand, but you can just see that the volume is picking up in here. And I think we went sideways a little bit. We came down. We might have made a lower low in here, or we certainly tested in here for another several weeks, couple more weeks, and then the market took off, and we've been making higher highs all the way since. Okay. Where would I have taken that trade? And on K, I'd be watching this market, and you could, this is a hidden up thrust in here. You can take it on the close. If you're an end-of-day trader, if you're a day trader, you'd see that it's, that it's in resistance here, right? This is that same thing: support over here, resistance here. And so as it's coming down through yesterday's high, there's a good spot to take it. If you're a day trader, focus on yesterday's highs and lows. They're very, very useful. It's a very useful thing. You see it all the time. I won't go into it now, but I mean, we do that every week in deep practice. Meet with a group of traders that we do this kind of practice. We do this kind of bar by bar stuff, and people seem to get a lot out of it. So let me just make some comments, and then we'll take a break here. This does take a lot of practice, especially trying to do it real time. It's not easy. It takes some real effort to do, and you make mistakes in the beginning, and it can be frustrating and stuff. But once you get the skill, it's really well worth it. Does it mean that you get it 100% right all the time? No, absolutely not. Absolutely not. In fact, I was looking to go short today, and it was clear to me in the morning, by the time we were actually before the open, that we weren't going short today. I wanted to think about going long. Maybe Wall Street was happy with what they thought the election was going to be. I don't know, but it was pretty obvious that it wasn't going to be a day to go sell short, and it's all because you can read it in the price bars. So you don't always get it right, but with the skill, it's really quite worth being able to develop. And the way to do this is just, if you're a swing trader, get daily and weekly charts over the past 5 or 10 years. And then if you're a day trader, look at the daily, the 30-minute and the 5-minute over the past year, or the daily and the hourly and the 5-minute or 15-minute over the past year, if you can get that data. And then, look at, I know a lot of you folks are from the VSA, apply those VSA principles like bottom reversals and tests and no demands and selling climaxes and stopping volume and all that. Look for that stuff, and then see what the market does afterwards, and start to piece together how the market really works on a bar-by-bar basis. It will tell you what it's going to do next. Not necessarily in the very next bar, but over a series of bars, you'll begin to get a good sense of what the market is likely to do on the next swing or the next wave. And look at the tops and the bottoms like we did here tonight, and also the continuation of trends, okay, and how that works. And basically what you'll see is that in a continuation, and we'll see this on on Sunday, you'll get a pullback, and that pullback, if it's, if we're in a downtrend, that pullback is going to be to the upside, and it's going to be with price bars that are overlapping, volume is light, spreads or ranges are going to be relatively narrow. And then there will come a point where you want to make the trade. And if you're in an uptrend, it's going to be just the opposite. The reaction is going to be light volume, and narrow spreads. And we only looked a little bit at it tonight, the higher time frame support and resistance. We'll do more of that on Sunday. But you want to pay attention to that because there's lovely ways to utilize the higher time period support and resistance, or the higher time frame support and resistance. And then, as I say, deep practice. I mean, it's a specialized kind of practice. You practice, people say practice makes perfect. Well, practice makes permanent. And if you practice poorly, you're going to develop poor skills, and you're going to make those pretty ingrained. You want to practice correctly, and it's a specific way of doing it. It's looking at a market, going through bar by bar. And as I said, we do this each week on a Thursday night. And we've got a good group of traders in there, and anybody's free to come in and join us if you like. We do this kind of thing just like we did on this last market, bar by bar, and going through it. And if we're, oftentimes a lot of day traders in there, so we'll set up a daily chart. We'll take a look at that first and try to figure out what's going on with the market on the higher time period, and then we'll trade that on the 5-minute the next day. And that's the kind of thing we do there. All right, so that is the first half of tonight, and Terry says he got David's wave for Metastock, and it really helps to see the waves and the wave volumes. Oh yeah, you'll see Sunday. You'll see it in spades. I'll show you some good stuff, I think. So let's take a 10-minute break. Is that enough time, or do people want 15 minutes? I think 10 is good. Yeah, let's just take 10. Okay, good. Yep. All right. So I've got here. Let's take a look at the time. It is 5:43. We'll call it 5:45. So let's be back at 5 minutes to 6 my time. That's Eastern time. Just adjust yourself. It's really a 12-minute break. That's what we'll do. All right. All right. I'm going to turn off the recording, or I'll pause it. I'm not going to turn it off. Recording again. Okay. So here we are in part 2 of the first half of this, or the second half of the first part, whichever you prefer. So we're going to talk about what I consider to be the backbone of Wyckoff method trade setups. And I talk about these all the time, springs and upthrusts in particular. And as I said, David Weiss will say that you can trade nothing but springs and upthrusts and do very well as a trader. And that is absolutely true. If you get, in fact, one of the things I decided to do when I was, for those of you who don't know, he's a Wyckoff expert in his own right. David is. And he was my mentor, is my mentor still. We still talk quite a bit, and he lives in Boston. I live down in Connecticut, not too far from one another. I go up and see him once in a while, and see him on different events and venues and things that I do with him. So when he said that to me, I made it a point to go out and really learn these springs and upthrusts, and I've gotten very good at them over the years, and they are clearly my favorite trade. They're my bread and butter trades. I do them all the time. Whenever they set up, as long as they're not in, if you're taking a spring and a downtrend is not a great idea in taking them, unless it's pretty clear that the downtrend is over, or you've got a good indications that it is over, like we saw on IWM, a selling climax and volume off the bottom and that sort of stuff. And when we saw in BHP the little spring that occurred at the end, or near the end of the accumulation area, we had a good indication that accumulation was occurring and that the downtrend channel indeed had broken. And that we were going sideways and no longer in a downtrend. So those are kind of the exceptions to it when you're in a downtrend. when you're in an uptrend, they're, yeah, I don't know of a better trade, tell you the truth. I think they are, the jump across the creek and the fall through the ice. Those are the best trades that are available. They just don't come around all the time. Springs and upthrusts, as I will show you, happen very frequently, and you really can work a good income off of them. All right, then we'll talk about jump across the creek and fall through the ice, and I'll tell you the stories behind them. By the way, none of these trade setups come from Wyckoff himself. Richard Wyckoff wrote the initial course, and what he would do is exactly what we did in the first half. He'd be reading the market bar by bar and looking at it and trying to assess whether there was supply or demand in the market, and then make his trades accordingly. After he died, shortly after he died, a fellow by the name of Bob Evans, Robert Evans, took over this little educational thing that Wyckoff set up before his death, called Wyckoff Associates, and it's now called the Wyckoff Stock Market Institute. It used to be based off of Wall Street, and now it's out in Phoenix, Arizona. At least I think it's still in Phoenix. It was when Craig Schroeder was running it, but Craig died recently, and I don't know the new person who has it. Jim O'Brien is his name. I don't know him. I've never met him. I talked with Craig. I talked with Gary Schuber quite a bit, but I don't know the new fellow. Anyway, I'm making a long story out of it. I'm sorry. Evans took over Wyckoff Associates and ran the education for them, and was very keen on helping people understand the market. And he would tell stories about the market, and we're going to talk about a few of them tonight. And the spring story is nothing more than this. Nothing more than this. We make a low here, and we establish support. And we've talked a little bit about support tonight. The market then rallies off of that support, and we have a swing high or a wave high, whichever you like. Market comes back down, and we shouldn't see real ease of movement coming down, and real rapid high volume down bars coming in here. Should be a fairly normal kind of reaction. And what happens to the market is that it dips underneath the low put in over at A, not the close or the high or the middle of the bar, but the low of the bar. It dips underneath that, and it immediately, usually within usually the bar or within a bar or two or three, the market will turn around and come back up and close back up above the low of A. And that will be a spring. And what we anticipate from there is what we call a good response. We want to see the market rally up, and the minimum initial target is the high, is that swing high between A and C at B. Okay? Okay, a couple of questions. Craig says, is it generally true that a spring or upthrust will occur after the trend line has been broken? It can, it doesn't have to. It doesn't have to. It can be a higher high that gets put in. Would you consider only taking potential springs when it closes above the previous low? Yeah, unless I see shortening of the thrust down in here, I might, or if I'm feeling cocky one morning, I might go in ahead of time. But usually when I do that, I am either way too early or I'm wrong and I get stopped out. And so I try to remind myself to just be cool and buy the thing when it closes up above support. I don't always do it, but in general, if you're just starting to learn this thing, do that. It's a much easier way to learn them. Now, there's a variation on the spring, that's important to know. That sometimes is very helpful to know. And I would say that if you are brand new to springs, unless you've got a lot of good experience trading, but if you're brand new to springs, I would wait for this particular thing to occur here, and that's a test of the spring after it pushes up above the low. So this is kind of a variation. Often we will see them just run right up, and there's no, and if you don't get in, you've got no chance of getting in. Okay, and you'll see that. And if you're just starting out with these, you're going to get frustrated. You're going to say, "Son of a gun, I could have had that. Look at all the points or money I could have made," and so on and so forth. Don't think that way. Just note those and note how powerful these trades are, and how good these trades are. Stick with this to begin with to get the feel for it, and then over time, when you get, when you've got a number of these under your belt and you've got good experience, then you can start taking them as they're occurring. But this is waiting for the test is the more conservative approach, but we don't always get them. Okay. All right. I notice a lot if there's a test after a spring. Yeah, it's pretty. You'll see it pretty well. I found springs where the low is the previous day's low is especially potent, as many traders keep their stops below the low of the day, and they love to hit those. Yeah, that's my basic playbook, is to play around. If I'm day trading, to trade around yesterday's highs and lows. And so yesterday's low was put in, and you're right, a lot of people put stops under there. And if the market in the early morning session goes underneath yesterday's low and springs back up, it's usually a very good trade. It's one of my favorites, in fact. Okay, here's a spring, exactly what we were just talking about, where this is an intraday chart, and here's the low put in at A, the rally up to B, and this goes sideways for a while, and then it comes back underneath C, underneath the low of A, dips underneath very, very lightly, and then immediately springs back up, and just takes off from there. And you can see here there's really no testing that occurs. Maybe you could call this a test. I don't know if I would, but you don't really have a great opportunity to get in. It just goes. And that's what we expect. And as I said, the minimum objective is a run back up to retest the swing high of B. And Abdul, if you notice, here's 1 day. And here's the next day, and this is in the morning session, around 11 o'clock, and this is actually the two-day low, which is very good to do too. So yeah, when you've got a daily low in here, and then you come in, whether it's yesterday's low or 3 days ago it made a low, depending on the structure of the market, and it comes down and tests that and then springs off of it, boy, you've got a nice trade. You've got a really nice trade. Here's another good example of a spring where we've come down. Now, I didn't draw trend lines in here, but we are in a downtrend, but you can see that downtrend line has been broken, right? You could even draw it like this if you thought that was right, and it still is broken on the test. But in any event, the key thing to note here is that we have the low at A, we rally up to B, we come back underneath. Now notice here, we don't immediately go up. In fact, we come underneath here and we spring up, and then we come back down again. So if your stop is really tight, you're going to get nicked, you're going to get knocked out, and then it's going to go on you, and then it comes back and has a nice little test. So they're not perfect, they don't work perfectly all the time. But if you see this kind of thing, let's say you got in here, okay, and you put your stop, jammed it right up underneath here. or even you put it a tick or two under below that. It comes back down and it takes you out and then springs. Okay, you know, you've got to lick your wound. Go ahead, Esther. Lick your wound. See if it'll come back and test. Here it does, and there's a nice trade opportunity for you. Okay, it's a very nice trade opportunity for you. Darren says, I noticed that a test after the spring will often come back down to the previous swing low. Is that significant? It's just, this is just like a little mini accumulation area in here. This is just on a small time frame, so they come back into the accumulation. They find no supply there. It would be this. This is the Weiss wave volume on this chart, which I'll explain on Sunday. But you can see that this move from here to here is this volume here, and there's just no volume on it. There's just no volume on it. And in fact, down here, there's no volume either. So, you know, there's no, if I usually don't trade with hard stops. If I bought this and I saw the market moving down, I'd see that shortening of the thrust. I'd see there's no volume coming in. I just wait for it to, you know, turn around and move forward, move back up again. So, okay, other questions here. What's the difference in a low volume and a high volume spring? Which one is likely to be tested? Yeah, that's a good question, Terry. Bob Evans had categorized springs into 3 different categories. He called them 1, 2, and 3. A number 3 spring was similar to what we saw here on this chart. A number 3 spring in Bob Evans's categorizations was we would have very low volume on the penetration, and the penetration down would be modest, would be just very small, okay? And this would be categorized as a number 3 spring. And this, he said, you could buy on its own. A number 2 spring would be, I don't think the one that, we don't really have a good example. If this volume in here would be this volume here. Let's say that this volume was just a little bit higher. Say like this, okay? He would categorize this as a number 2 spring because it penetrates more and the volume is moderate, okay? Not light, but moderate. These, he said, you would always have to buy a test. And then he had this sort of weird thing. It was called a number 1 spring, which was basically the market keeps going down. The market goes underneath it would be as if it goes underneath this support and then just keeps going and going down. I don't know why he called it number 1 spring. It didn't make any sense to me, but that's what he did. Anyway, what I've found over the years is that the volume probably doesn't really matter all that much. The volume, I've seen very high volume on springs. We saw that one on IWM, right? That on that first chart where the volume was very high. It was bar A, I think. The volume was very high, but that's really volume off the bottom. So, you know, Bob Evans would say you'd want to have that tested. And it tested on IWM. It did come back and test at F on that chart. But, you know, these days I just trade springs when I see them. And sometimes I will anticipate them and I will go in beforehand. On this kind of a setup here, I might do that. If I were watching this in the morning, I might buy this here as it's starting to rally. Instead of waiting for it to go on the close, I'd buy it as, you know, on the rally and see if it would push through. why would I do that? Well, I put the trend channels in here, right? And we don't really break it until D, until we rally up above here on D and then come back and test. However, look at what the market's doing. At B, we would, if we originally drew the trend line like this, we'd readjust it at B, which is the issue with diagonal trend lines, okay? We would expect now, when the market reacts off of B, we would expect that market to come down here and come down towards this trend channel here, right? But what does it do? Just the opposite. It holds up in here. So there's not a lot of effort needed. If we were to extend this out, we're in here, there's not a lot of effort needed to break this downtrend line. So that's telling me that the market is much stronger than, what it might first appear, what it might look like when you first look at it. So that's one benefit of using this trend channel in here, is that we're far away from the lows of this trend channel, the lower line, and we're very close to breaking the downtrend itself on the spring. We should see it. We should see the spring break that line. So that would tell me that this is a very high odds spring, and that I could be, somebody who's traded these for a while could be aggressive in this, and make a trade in here. Okay, but as I say, if you're just starting out, this is fine too. I mean, maybe I got 2 points more out of this trade, or 1.5 points more, I don't know, than I did off, from when it got tested. It's better when you're first learning them to do things that don't increase the anxiety too much, and just trade them straight. So wait for the tests if you're just starting out. No, look, use trend lines too, just classic trend lines here, where we would put in, this is what we call a demand line, the bottom line here off of this low and this low, or this swing and this swing is fine too. And then just make a parallel of those and put it on the intervening highs. And look, it tells you, I said the initial objective is here. We had already gotten that and then came back and tested. So now what do we look for? Do we go all the way up to here? Maybe if we got a good response out of this. But look at what we get. We get kind of a choppy response. It's not that great. So you put the trend lines in, and you know that you're overbought up here. And so in here somewhere is a good place to take it off. And if you got in somewhere in here, say 108, and you took it off up in here at, let's say down here at 116, well, there's a nice 7-8 point trade on the S&Ps, and they're worth $50 a point. So if you got 8 points out of it, that's $400 per contract, right? You can scale it up on those contracts. That's why we say that you can, David says you can make a good living off of this. Okay? All right, bunch of questions have come in here. Let's see. Would I consider the first dip after A failed spring? I probably wouldn't be taking this because of this kind of action in here, and I know that we're still in a downtrend, and I haven't seen much of any real reason to go long in here. So I would notice this as a spring, but this would be still in the downtrending condition. It wouldn't be of real interest to me. It seems that spring, says Abdul, can be found in an uptrend or in the change of trend. Are there different characteristics of the two? Is there one you trade more than the other? That's a good question, Abdul. There is good answers to it too. The springs that occur in a downtrend when the downtrend is over like this will typically have an accumulation area, like we saw on IWM and we saw on BHP, and we're even seeing in here. Okay, we're even seeing here. I don't remember if I've got some springs in an uptrend that you'll see the differences. So one of the things you want to do is you want to look for that accumulation area, okay? Which is just trading around the same area, the same zone, going above it and below it, dipping into it, and then coming back in and testing it. When we're in an uptrend, there are a couple of nice setups that occur, and I've got some examples coming up, so I'll show you what those look like. They're different than this, and I'll show you two that are really choice. And when I say choice, I mean they're really, really good when you see them, and I'll show you those. And they have a little different look than this. But it's a good question. I'm glad you asked, and I'll be sure to highlight that. Spring is a structured trade based on price action. It absolutely is. It absolutely is, because you've got a defined, thanks Rama for saying that, to remind me about that. You've got a defined support point. We want to try to trade near those edges of support and resistance as much as we can, or as close as we can. And a spring defines that for you, and so does an upthrust. And as you'll see, so does the jump across the creek and the fall through the ice. They all do that for us, which is a real advantage in trading. Are the structure and volume prior to the spring bar more important than the spring bar itself? They factor into it, Ivan. Yeah, I don't see, when I saw this here, when somebody said, what about this, spring here at A, when I see something like this, I'm pretty cautious about that, because I don't know what it's going to do next. When a spring fails, and I don't remember if I have an example here, I think I do on Sunday stuff. When a spring fails, it's typically not going to go, it's not going to, spring up and then go straight down. What it'll do is it'll go sideways, and it will do what we call hug the bottom. If I don't have an example, I will have one for next week of a failed spring, where it just hugs in here. It doesn't rally away from the danger point. This right here, the low, is the danger point, because it's the point at which the spring will fail, and it will take you out of your trade at a loss. So your stop is going to be down there somewhere, right? So that's the danger point. What we want to see in the spring is that it rallies away from the danger point right away. And here it does, right? It rallies away nicely. Here, it just hangs and goes sideways. Well, if it did. And then, the odds are good that it's unable to rally away. So if it's unable to rally, it's going to come down. Now, the nice thing about the spring hugging the lows is that if you're attentive to it, it's telling you that this thing isn't going to go, and it lets you get out gracefully. In other words, you can get out at break even, or a small loss, or a very small gain. It'll let you get out gracefully, which is another reason why I like the springs. Very, very rarely does one spring and then bang, knock you out. That's a very rare event. It almost always gives you a chance to get out gracefully. So, good question there. So a spring, stop it, Asta. So a spring doesn't have to be created by just one bar. It can be the effect of several bars. Yes, because this would just be a spring on a higher time frame. That's all. The third to last bar, would you consider that as an up thrust? 1, 2, 3. This, it's a hidden up thrust, yeah. I'd call it a hidden up thrust. The second attempt to spring more powerful is the second attempt. Here you mean? Yeah, because it does. It's just, this is just one of those instances. This happens in the S&Ps where it just doesn't do what you expect it to do right away. Look at how many times it came down here. Once, twice, 3, 4 times before it finally decided, no, I guess it can't go down any lower. It's just the nature of this market. We might get in here and we might get nicked, and then it holds in here, you go in again. You know, it's losses are nothing to be thinking about. They're just cost of doing business. You don't know. You don't know if no one knows, except for maybe God or somebody. I don't know, but no one knows. I mean, this looked good. This has got shortening of the thrust in here. It's a perfectly good trade to take right here. Bang. Look, there's not much volume coming down on this. It just doesn't go on that round. And you don't know that it's going to do this. And this is one of the few times where it doesn't give you grace to get out if you've got a really tight stop. But it doesn't. You don't know that it's not going to do this right here over here, right? It just doesn't, and there's no way to tell it. Springs are, this is as we talked about in Australia and in Singapore and KL. It's a game of probabilities. These trade setups have a percentage win-loss ratio. You know, springs are probably in the 80% range. Probably in the high, if you're trading them intraday and you're close to the market, and you're good at it, you probably can get it into the high 80s. But you'll still see stuff like this. This might be one of those, 10 or 12% of the time where it doesn't work. Like here. So it doesn't. But look you might have lost 3 points in here, and you gained, what do we say, 8 on a test, and maybe 10 if you got in aggressively. And if you're really, keyed to what's going on up in here, you could have squeezed, instead of 8 points, you probably could have gotten 9 or 10 out of it, 9.5. So the spring before C after B, the one that sort of fails, would the down bar 6 previous keep you from taking that because the supply increases where the next bar after the supply decreases? No. I just look at this and say it tried to go underneath and it didn't do that, and it's coming up. Okay, I think we've beaten this one up enough. I think let's move on to the next one here. Here's a spring in an uptrend, and here's what I wanted to. Here's one of the things, Abdul, that would be useful. If we were to put little trend channels on here, you could see that this would be pretty cool, right? So we get oversold down in here and in here. So that's one way to think about these, okay? But there's a better way. And that is, in an uptrend, we will often see, now this doesn't have anything to do with Wyckoff. Wyckoff might slap my wrist for saying this, but it's more about Elliott wave. An Elliott wave and the Weiss wave and the Wyckoff wave have nothing to do with one another. Just that Elliott discovered that there are corrective patterns in a market. When a market's going up, to be very basic about it, he said they would go up in 5 waves. These would be called impulse waves here, waves 1, 3, and 5, and waves 2 and 4 would be corrective waves. Okay, so impulse or motive waves and corrective waves. And he said that, impulse or motive waves always go in 5 stages. I don't know if that's really true or not, but generally that's probably true. Corrective waves, he said, would be, they could take a variety of forms, but one form is this A, B, C correction down. Okay? So if we were going, say, from 3 to 4, here, wave 3 to 4, we would see this A, B, C down, and then the market would go on up to wave 5, right? So that's the basis of this. Look, A, B, C, and a spring. They're lovely. A, B, C, and a spring. Very powerful. What happens on these is that you're in an uptrend. And this is, you've got to have an uptrend. And the way we define an uptrend is you've got a high and a low, a higher high, a higher low, higher, high, higher, low. It's not real sophisticated, but it does the trick, okay? If we're in an uptrend and making higher highs and higher lows, so that means that no higher low goes below this low, okay? Then that's not a higher low. As long as this is happening and we get these ABCs, the odds favor that they're going to be corrective waves, and when they spring, they can be very good trades, and they go on for a while. And unlike a regular spring, where the objective is here, an ABC spring, the objective is to put in a new high, a new swing high, okay? So it's not just to be here, it's to a new swing high, but this is only in an uptrend. All right, so this is a difference between what we saw earlier and here, okay, and an uptrend. Now this is the Aussie dollar back in, this is the June contract at 240, I'm sorry, the September contract on a 4-hour chart. And a lot of currency traders use the 4-hour. It's a good currency-based type chart. And you can see that, just take a look at this period of time, whatever this was, from June to the end of July, mid-June to end of July. We have 2 beautiful springs, just gorgeous. And that's a lot of money in a futures contract to be able to pull this kind of a trade out. You know, and if you did the basic kinds of trend channels, you're going to know where to get out. Right? You'll know where to get out. Okay? So, Abdul, that's one good example of a spring in an uptrend. Okay. You're a big student of Elliott waves. Well, let me tell you, I don't like Elliott because I got killed in it. I traded it. I even hired somebody to teach me how to do it, and I lost the most money I ever lost in trading. And I still shudder when I think about the amount of money I lost trying to trade that thing in the currencies, in fact. And I just can't do it anymore. I don't do it anymore. But that being said, what I think out of all the Elliott stuff that makes the most sense to me are these little ABC things, you know, and I just love them. I really do. When I see these, and I see them all the time, I see them on the intraday charts and stuff. I think they're really good. I think they're really, really good. Okay, tell me now where the springs are in this. I always do this with this chart because it's a good one. And I'll show you another way to think about, Abdul and everybody, to think about how to trade springs in an uptrend. Where are the springs here? One's in September, yep, right here. Good. One's in December. Yep. And this one we took in a class I was teaching, the first or second chart reading mastery class I ever did, I forget. And we bought this spring and we traded it for a nice 10-point move. And one in October. Very good. Yeah, one in here too. There we go. Those 3. Okay. Now, what makes these springs so good? Well, first of all, we're in an uptrend. Let me back off here for a second. First of all, we're in an uptrend. Whoops. Got too excited there. So first of all, we're in an uptrend, okay? And we do have an ABC here, which is why I was excited about that. Okay. The other 2 really aren't. Notice this one's just going along sideways here, not doing much of any kind of pullback. We saw that earlier in the NVIDIA chart, I think it was. and then it goes, dips underneath the lows, and then springs up, and look at, we get a nice, look at the response here. No testing now on this, right? When they're going sideways like this, and really when you're in an uptrend, I don't bother to think about tests at all. Still, you should as you're doing it, but you'll find that they will run very nicely, and this is a good response to this spring. Here, the same sort of thing. We go for a whole month here of doing nothing but going sideways, and then finally we dip underneath and then rally up, and again, a good response. Look at that gap up into gap opening and just pushing right up for new swing highs up in here. It's very nice. But there's another element to this too, and that is that, as we saw earlier, we were looking at downtrend charts, and so we saw that, you know, support came in, and then the market rallied, and then market came down through, and then it came back up again, and it served as resistance. Remember when we were looking at all the charts with the IWM, BHP, both of those had that. Well, it's the same thing in the reverse. If we're in an uptrend, we see a little bit of resistance here. Once the market breaks through that and comes back and does that stair-stepping kind of action, then you're back on top of support here, right? That's a really nice feature of an uptrend that we don't get at the end of a downtrend, okay? So this is trading on top of support, plus it's a spring telling you it's refusing to go lower. Boy, how much better can you get, right? That's really nice. That's really, really nice. And the same thing occurs here too, where old resistance turns into support. So the ABC and this resistance, you know, sitting on top of support, which was old resistance, those are the two key things in an uptrend that you're not going to find in, you know, in other versions of springs, and they're very powerful, very, very powerful springs when that happens. Okay, are they small reaccumulation areas? I guess. I don't think about it that way, Darren. I just think that, you know, the market moves up quite a bit, and they need time to consolidate and digest this new price level, and then it rallies up again. You know, that basically is how I view it. It's just that the traders are dealing with a new level. Here's another good example. This is XOM on a daily chart. Is there a mini spring in late July? July. Not down here, no. No, I wouldn't consider this, you mean? Because here's a day, there's another day, and then there's a spring? No, I wouldn't think about that at all. It has to make a support, rally a bit, and then come back down. Or it does this sideways thing. It makes the support and holds this level. Makes a support, rallies, and then comes back down. One day in between. On a day trading basis, sure, that's a nice, you know, the 2-day low, that's fine. Or if you're thinking it's down here and then up, I wouldn't call that a spring, but I would certainly notice that. I would notice that, and I'd be looking for any opportunity to go long. Okay? All right. Okay. So here's XOM, same kind of idea. Look at all the resistance that occurred here. Don't you think that's going to be good support when that occurs? And then we get a spring off of that. That's just picture perfect. And then we just rocket off. A very good response to that spring. And this also is an ABC type of setup. And so we don't look just to go to here. We look to exceed this high, and we certainly do. Okay. I call those power springs. Here was another spring example in the S&Ps on a daily basis. This is the futures, the ES contract. This is, look at all this volume. Look at the block of volume coming in here. Compare that to all of this, right? So what happened here? This was when Moody's and Standard & Poor's decided to get serious about their business, and they decided to downgrade the U.S. government bonds for the first time in the history, I think, and the market sold off dramatically. Then we go into this 2-month trading range, and we come down here, we dip the low. Look at that, beautiful. Modest penetration, and then rally up, and then it takes off. No real test. And I don't know, people have asked me, is this a test of the spring? I think it's more a test of the trading range in this high volume as opposed to the spring itself. I don't think the spring ever really was tested, but I put this in. I mean, you could consider it a test of the spring or the trading range. It doesn't really matter. It tests something down there and then takes off, and we're still making new highs from that. Okay. Now here's one that's an interesting one. And you're going to say, but Gary, this is in a downtrend. And it is. But this is what you can do with skillful chart reading. This was a trade I took in when was this? Let me just see. August. This was a trade I took in a VSA club event with the Trade Guider folks. They were having a live trading session, and I did this. This was a spring here of yesterday's low, and Abdul or somebody, I forget who, maybe it wasn't you, Abdul, but somebody said springs of the daily lows are really good, and yes they are. Yes they are. Now, so down here there was a spring that occurred, and I was cocky that day, and that's why I don't like to do those live sessions too much, because I always feel like I'm under the gun to produce a trade, and so sometimes I will let the psychology get the better of me, and I'll I'll make my bonehead plays. I still make them. I still do stupid things, and probably always will, because I'm a human being, right? So I got in, I think probably over here on this bar or something. I don't know when I got in, but I was sitting through this for like 40 minutes, and I said, geez, this is going to drop down. I'm reading this wrong. I don't know what I'm doing. I'm getting out of here. So I got out, and it immediately springs and rallies up, of course, right? But I was pretty good that day. I saw the test at D, and I bought it right here on the lows, and I took it up. So it was a good trade. It was a nice trade. Now, so you're going to say, well, Gary, that's in a downtrend. Yes, it is. But I have 1, 2, 3, 4 days here, okay? We'll just number these. And I can put in a trend channel in here, and I see that we're at the bottom end of the trend channel. Just as important as that, we're at the bottom of the trend channel, and we're playing around yesterday's low. So it's either going to, just fly to the bottom, or it's going to fly to the moon. One of the two things is going to happen. And what I looked at, which really made sense to me, was this. Here's the day's close, and then somewhere around here we're close to the U.S. Open in here, and this is the amount of progress that was made in that 12-hour period, or maybe a little bit more than 12 hours. Okay. Compare that to roughly the close here, and about the same time period, which would have been about here, the previous day, and look at all the progress made overnight there. Okay? So that's pretty good wave down. This is not much at all. They're struggling they can't bring it down much lower. Okay, they can't take it down. Here it was easy to move the market down. Here, not so easy to move the market. Okay, so now there was a spring here of this day's low, but this kind of price action tells me probably not a good one to be taking. This kind of price action on this day's low tells me this is pretty good, and it did work out. Okay, and what we want to see is good response from that spring, and we do see that. We see that nice push up, and look at the upside volume that came in on this wave here. Not only do we see a bigger wave, which is from this low here to, or this level here to this level, but we saw a good volume coming in on this. All right. So when I'm talking about thinking about making trades in the market, it's not just about reading a price bar and putting in a couple of trend lines. It's thinking through and trying to be rational and logical about it. And what's the market done recently, and how does that compare with similar moves that it's done recently? And so I just compared this from the close to here with this close to here, and thought that, okay, there's a story here. It's hard to move down, we're overbought, and we're hanging near yesterday's low. It's probably gonna spring. Let's take a trade in here. Okay, that gives you some of my approach to my own trading. I'm kind of giving you a little bit here. According to Wyckoff, doesn't he say that the best entry on the first retracement of a brand new trend move, point C, which is also the start of wave 3 in Elliott and no supply in VSA? He might. No, he didn't say that, actually. He said the best place to take a trade, if you can get in on it, is a selling climax. And then a test of a selling climax. And after that, the break of the first high. So let's just pretend this was climax here, okay? He would say buy here, buy the test, and then as it breaks the high and proves itself, buy here. Those are the three places that he would buy, at least that he wrote about in the course. He did a lot more than that on a swing trade basis, but he never waited until way up here to make a trade. He always tried to get in at the danger point, and he said that this is the least favorable place to put a trade on, is the break of the high here. The last swing high. It's the least favorable. You remember that day, Brian? That's good. I almost forgot it myself. Okay, good. Okay, good. So that's just an example of a trade that I took on a spring. We'll do more of that. I've got a good one with next Sunday too. Trade that I took. Okay, up thrusts. They're pretty much the opposite of a spring. They make a high here, which forms a resistance level. We sink down, and then we up thrust that. We go up above it, fail to go higher, and then come down. And just like a spring, these often will get tested, and this is where the VSA idea of no demand comes in. It's the same idea. I call them a test because I've always called them a test. Wyckoff used to call them secondary tests. Tom Williams cleverly calls them no demand because that's exactly what they are. And so you can, whatever term you use, it doesn't matter. What's important is that you understand the concepts. So that's let's just see what you guys can see. Where are there up thrusts here on this daily chart of the Aussie dollar? March. Yep. There's one here in March. That's right. There's one in December. Yeah, good. And February high. February? over here. Oh, up here. Oh, this? No, I wouldn't consider that one. No. No. Or if we do, it's just going sideways and it keeps up thrusting in here. And then there's one in May. That's right. That's the way I see it too. So there's 3 nice trades there, right? What one do you think is the best one here in this? Of these 3, which is the best upthrust trade, do you think? And why? The middle one. Why is the middle one the best one? And why is, and somebody says, a couple of people say May. Why is May the best, do you think? May's in a downtrend already. Yeah, that's what I would say too. This is good. This is the best. This is, I would say this is number 1 in terms of choiceness, because we're already in a downtrend. And if we were thinking about wave structure, we've got a good sized down wave that's occurred here. Okay. The next best would actually be this one. Most people would think it's going to be this, but I would say that that's the 3rd best. The next best would be this one, because we had such a steep pullback and then this hypodermic up, this effervescent rally up, and then it just goes sideways and up thrust. It doesn't give us all that much, but in terms of good quality trade, I would say that that would be the 2nd best. This is the least. It is an upthrust. It's the least because a couple of things. We're kind of holding gains in here. We're not really seeing much of supply in here. Plus, we just made a good wave up, didn't we? And we've got small wave down. So this to me is the least choice of the trades. Doesn't mean you can't take it. And if we look at this a little more carefully, we can see that it does test in here, right there, and makes a nice test. Here, no test. Here, no test. There's a nice test. Okay. So while you may or may not have taken this, then you could have said to yourself, that's okay, and I would look for this now to make a lower low, and it does. It starts making lower lows. But because we're already in a downtrend, already the wave structure has changed, that's the best one right there. Okay. According to Gavin, says Abdul, you would be looking for a principle for that upthrust 3. Is there a principle in this example? Principle in upthrust, in upthrust 2 rather. No, not really. And there is a bit of an upthrust here too, although it's a lot more. This is a daily chart, so maybe on a weekly basis. It's not really upthrusting on this time frame. And the difficulty is this. It's got a big wave up, so there's no real principle there. From a Gavin perspective and a Tom Williams perspective. Here's a principle, though. Here's the Japanese yen on a daily basis. And we're going, I don't know what we're doing here. We're doing some sort of sideways movement, and suddenly the bottom drops out of this market. And we have a big downdraft here. And we sort of muck around going sideways into this fairly protracted trading range of many months. And a couple of things to note. As we come down here, well, as we rally up, as we would expect, we come back into this trading range here and into this big supply bar, and there's just no volume coming into the upside. as we come down to 3, volume picks up. So there's still supply here. We know that, or we don't know it per se for sure, but we can guess that, right? We rally up and we kind of hold in this level here. And then look at what happens as we come down. More supply comes in. More supply comes in. As we rally up, look at the volume. Dies right out. Just dies right out. Look at the spreads. They're narrow up there. Look at the shortening of the thrust in the price bars. It's very hard. There's just no desire to move this market higher. So what do we have here? We've got supply, not much of a rally, supply, supply, a very weak rally, no demand, shortening of the thrust, and then as we break to underneath on this up thrust on bar 6, we pick up volume. That's pretty nice. And look at the response we get. You get a little no demand thing here, but that's about it. So why is the up thrust so good? Because we're trading against the edge of resistance here. And we're getting in close to the danger point. And this thing starts to move right away, and it just confirms that we have a very good trade on our hands. But it's all set up by the supply that we see here and here and here, and the lack of demand up in here. So it's a little bit more of a story that goes with these things. We'll talk about that on Sunday. Could this be seen as an up thrust following distribution? Maybe, but I don't know what went on beforehand. For distribution, you need an uptrend. Then it goes sideways, protracted sideways, and then it has an up thrust. Okay, here is something I want to highlight, is that here are up thrusts, right? Look at these guys. Why don't we want to take those? They're no good because they're in a strong uptrend. That's right, in a very strong uptrend. And we don't want to be playing that game with this. In fact, look at what we have here. A nice uptrend. We have an A, B, C spring. Boom. That's the trade I want to take. Not be trying to pick a high here and sell the high tick. So up, even more so I think than springs. It looks like it's up thrusting, but it's always, if it's in an uptrend, it's 90% of the time it's false. So they're not worth trying to trade when you're in an uptrend. So you don't want to do that. All right, let me talk a little bit about, somebody was asking about gold the other day. Here, this occurred a while ago, but it's a nice illustration. Here's gold, the futures contract. We're in a strong uptrend. And then I was in India when this happened, and I wasn't able to trade it, but I saw it. In September, this thing just skyrocketed to the moon and became overbought in the trend channel, and look at the high volume, and it's climactic. This is what we would call a buying climax as opposed to a selling climax. Remember, on the selling climax we had wide spreads, big volume, we broke down below the downtrend channel, and we also went, we plummeted, right? Well, here we're going parabolic. We're going straight up. Those are all the hallmarks of climactic action. Now this is on a weekly basis. So let's go over to the daily, because there's a lot of emotion, a lot of jumping up and down, and a lot of people trading, a lot of people saying, oh man, I'm going to make so much money and blah, 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 right? It's hard to trade these. Okay, so here's A and here's A. So you get the idea, and this is 5, and this is 5, okay? So we rally up and we start getting volume coming in on these high bars here. Look at bar number 1, down bar. Do we see a big down bar since the move up off of A on that kind of volume? No. Even the 2 bars preceding it, especially this bar, is on this volume, and you can see supply coming in. This is early signs of supply coming into the market. All right. Don't necessarily do anything with that except for be alert to it, and especially if we're long, we start thinking about lightening up and getting out of our position. We come up to 2, and look at what happens on 2. Similar to bar 1 on about the same kind of volume. And then look at the move down to 3. Look at the volume that comes in from 2 all the way down to 3. Now go back over here, and that's this week's volume right here. The highest volume for years coming in here. This is a blaring sign of weakness, a huge sign of weakness. Okay. Now as we rally up, what's volume do? Goes to the downside. It recedes on the rally. Up thrust. Oh, picture perfect in the right spot. And look at the good volume, all that selling coming in. A little test of the up thrust here. On an intraday, it's a hidden up thrust. And bang, it goes from whatever this was, 1900 down to 1600. Okay? This is a way to use multiple time frames to see what's going on when you suspect this is buying climax, but you're not sure because all of the emotion and all of that that's going on. You can dissect this bar by bar and look at it and determine what's happening to it with this market by just some of the basic things that we've talked about tonight. Make sense to everybody? Is that helpful to you all? Okay, good. 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 Very good. Okay. Appreciate that. Okay, here's Boeing. Another set of up thrusts here. Up thrusts are gold, I think, in a downtrend. Look at this. Beautiful. Weekly downtrend coming down. We rally up at A. We have that A, B, C. You can't see it here, but this is 1 and 3, 1 and 3. This is the daily off of the weekly. Okay. What do we have here? A, B, C, up, and then an up thrust. Oh, I love it. Okay. It gets tested at 2 over here, and it goes down. We're looking for a new drive down to a new swing low, and we get that. It doesn't, you know, lots of times they'll go much further than this, but we get what what's promised on this trade. We get it, and it starts to get shortening of the thrust in here. We get a reversal bar. Some buying is coming in. We can, if we can see that little accumulation in there. It would tell us to exit out of our trade if we're long there. Okay. Now on the weekly, it's also a spring in here, but because we're in such a big downtrend, does it work? Yes, but where does it go to? It just goes to the top there, right? Doesn't really give us a great trade. It gives a good trade, but not a great trade. It's it's up against this support and stuff. You could make a case for it, but it's still in a downtrend. When we get up here, we can see that the rally up is coming in on light volume. We just go sideways. How come we're not breaking to the upside there? Volume starts to build in here, and nothing happens, and we get an up thrust. Then we see volume come into the downside as the price moves down, and on 5, what happens? We get no demand test in here. We get a test of that up thrust. Okay? We drop down. I put little S's in here. More supply coming into the downside. We do another little A, B, C rally on a small scale. Right, up to 6. Up thrust. When we're in a weekly downtrend. Gee, how much better does it get? There's one I didn't even put in here. Here's another one. This is number 7. Okay? So you can see that once a trend gets going, these things can be very, very profitable, very, very good trades. But you want to be reading the supply and demand relationships, lean against the higher time frames, and just look for these opportunities to occur, and they occur all the time. Can we have some examples of ABC patterns followed with spring or upthrust for our records, please? I think I'm showing you these, right? Some of these ABC things as we go along. I'm not quite sure what else that you would want from this. But try to clarify it, and I'll see if I can't help you. Here's BHP on a weekly basis. It says upthrust. It should say springs and upthrust. Here we're in a nice uptrend on the weekly. We get a spring, right? You can see that here on the daily. And we get a nice push up. Look at the beautiful response from that spring. It gets a little climactic up there. And then what happens? We come down. The structure is changed. And what do we get here? We get an ABC spring, ABC upthrust to the downside. Look, A, B, C, upthrust here. And that's at resistance. This was support, now it's going to be resistance, right? Just like we saw on the spring. I didn't put charts like that together, but it's the same principles, the same principles. And you can see the waves coming down are much bigger than the waves going up. Yes, but they'll be gone after today's session. Well, yeah, but you'll have the video, so you'll be able to see them on the video because we've recorded this, and you'll have that on the recording. Okay, criteria then for springs and upthrusts. And as they say, they're mirror images of one another. And as we talked about, they work best. Springs work best in an uptrend, or when there's clear evidence that the downtrend is over. And the same thing with an upthrust, just in reverse. They're going to be best in a downtrend, or when the evidence is clear that the uptrend is over. Okay, you can see that clear supply coming in and the lack of demand that is operating in the market. So on a spring, the price puts in that support, then rallies off of it. It comes back to that support level, dips underneath of it, reverses, and then closes back up above it. And the key idea here is that it's demonstrating to us that there's a failure to follow through to the downside, that there's a real lack of supply there. And we anticipate that buyers will see that and drive price up, oftentimes very aggressively. And the upthrust is the same thing in reverse. We get a resistance level that's established, a reaction occurs, the price then returns back up to that resistance level and goes up above it, but then can't hold it, reverses and closes underneath, demonstrating a failure to follow through to the upside, which is a lack of demand, and we anticipate then that selling comes in and drives price down. Now, I was doing something for Tom Williams' last mentorship course. He invited me to come. He asked me to come in and do a little bit of work with some of his traders. So I just put this. I just went back at the time. This was in early or towards the end of October, and I went from October into roughly a month period here. And this is the S&Ps on a little bit of a higher time frame. This is a tick chart, so this is 45,000 ticks, probably about a 45-minute to an hour chart, depending on the day. Okay, so as I said, you can earn a living, a nice living, off of doing nothing but springs or up thrusts. And you can see you've got an up thrust. You got 1, 2, 3, 4 good up thrusts that did really well, and you got 1, 2, 3, 4 good springs that did quite well as well. Okay, just as a look at that. And here's the same, roughly the same period in the Aussie dollar, and I don't know, we have 5 up thrusts and 4 springs. Okay, 4 springs here, all of which were good. I put this in because, let's just talk a little bit about this. Why would this be such a bad spring to take? I put an X there. It's in a downtrend, yes, but there's something else going on too. What else is going on? Definitely in a downtrend, because we're making lower lows here, right? It's just broken support. Yes, good, Ivan. Here we have a good support level. It's going to be real tough to get up above that. Okay? Look at this. You got, all of this in here where there's been trading activity, and you think that it's going to go up above that now. It's not going to do it. The odds are very low that that's going to happen. Has it happened before? Sure. On occasion it will do that, but the odds are very low that it's going to. The choice trade was this right here, was this up thrust right there. And you can see that, on some of these, when you get a good downtrend going, then you see this stair-stepping kind of thing, and you get that up thrust against that stair, against that old support, which is now resistance, and it's a picture-perfect trade. It's a picture-perfect trade. If it's a downtrend, is it really a spring? Yeah, technically it would be. It would be a spring, but we would just say that that's not a spring we want to take. It's just not a good spring, that's all. Oh, I forgot. I'm thinking, oh, we're almost done, and I'm finishing early, and I'm thinking, oh no, I got 2 more trade setups to go through. Okay, so that's springs and up thrusts. We would note it, Fiona, because the market is probably going to try to rally up from there, and we would assess that rally as it's going along. If it gets really robust, then we know something's changed in the market. So we don't want to just ignore the fact that the market dipped underneath support and then closed back up above it and starts to move on that, because even if we're in a downtrend, because there may have been something we missed or something we don't know, and that might be an indication that we're going to get a good rally. But so we're alert to it, but we are anticipating that there's not going to be much of a rally. And if that's the case, then we see that off of a spring, we can actually look for a short opportunity, which occurred in the Aussie dollar on that second or third up thrust there. Yeah. Okay. All right. Good. Okay. So jump across the creek. It's probably the best trade setup I know. This one in the fall through the ice. They're even better than the springs. The only problem is they don't happen all that often. So, but they're important to understand because they are structural elements in the market. So the jump across the creek, it's a story. And let me tell you the story. So you have that. It's a story that was created by Bob Evans, who owned Wyckoff Associates, or ran it for a while. And he used to do a weekly tape series. And when I lived in New Jersey, which is across the river from Manhattan, New York City, and I used to go into New York City, Lower Manhattan, every day to my office when I used to work in an office. And I'd ride the train, and you know, Bob Evans did these back in the, really in the, it started in the 40s, 1940s, and did them extensively in the 1950s and 1960s. So, and he would always have a chart with it. He'd talk about two stocks usually, or two topics, and they'd run about a half an hour each topic, and there would always be charts. And so you would see, you know, stocks that I never even heard of. They don't exist anymore, like Fairchild Camera and American Rubber Company, and you know, stuff like that, railroads and that sort of thing that no longer exist. But the principles are all the same, and the you know, it doesn't matter if it was the 1940s or 2012. It's the same stuff over and over and over again. Because why is that? Because it's based on human behavior, and human behavior, despite all of our technology, you know, it seems like, boy, just you know, we were doing Xeroxing. You know, I don't even know anybody who makes copies anymore. It's all electronic, right? We scan everything these days, and cell phones. We can't live without them. I didn't have one, you know, 10 years ago. They didn't exist, or 15 years ago. So it seems like all this technology that we have, that things change so dramatically, and we need more technology and stuff. But the secret to the Wyckoff method is that it's not based on technology. It's based on human behavior, and human behavior changes, yes, but it changes on an evolutionary time frame or timeline. It doesn't change in a 5 or a 10-year period. So that's why, even though this stuff wasn't written about, it was written about 100 years ago or 80 years ago, it's still as fresh and alive today, because it's all about human behavior as reflected in the stock charts. So just kind of keep that in the back of your mind too, that we really don't change as a species. We won't change for another 100 years or 200 or probably another 5 or 1,000 years. Okay, what are you doing? I don't need you to be doing that now. Okay, so Jump Across the Creek. It's a story. Evans used to make up stories as a way to help traders understand what he was talking about in terms of principles in the market. So the story here is about a Boy Scout. In the 1950s and 60s, they were very popular here in the United States. Still are popular, but back then, I mean, every kid was a boy. I was a Boy Scout in the 60s. So it's a story about a Boy Scout, and he's starting here, and his camp is out here, right? He's got to get to his camp, and he's walking along, but he's got to cross this creek or this river. Creek is the same as river or stream, okay? And he comes up to this point, but he sees that the river is too wide here, and he can't get across. So he turns back down, he comes along, sees the river again, comes up to the river, says, "Can I get across it?" "No, can't do it." Right? Comes up to this point here and sees, boy, the river has thinned out. It was really wide and fast over here. Now I can probably jump across it if I get a running start. So that's what he does. He gets a little bit of a running start, runs across, jumps across the creek, gets across. But all this walking and all this jumping and running, he's a little bit tired, so he takes off his boots, comes back to the edge of the creek, sticks his feet in the water for a bit, cools his feet, and then later on goes off to his campsite. Okay? So that's the story of the Boy Scout and the creek story. the idea is this, that there's supply here, and there's supply here, and there's supply here. And the market is not able to get across that supply until this point, until it's able to jump across that creek of supply. And on the jump, we will typically see good volume, good spreads, and if we're looking at waves, a larger wave up. And almost invariably, it will come back and test this supply area to make sure that there's no more selling before it goes on up to higher ground. Now, this creek story can occur in two places. I've shown one here. I didn't show the other example because it's fairly straightforward, but the creek will come in after some climactic, after a downtrend has been broken, either through climactic action or we get outside of the downtrend channel and we go along sideways here like that. But there's an accumulation zone that's created in here. And then once the accumulation is done, the markup starts, and the markup begins with the jump across the creek. Okay? Is a spring often used to get an extra jump across the creek? Asks Abdul. Well, you kind of read my mind. Sometimes you can get in early on this, and if you've been in a downtrend and you see a little climax and the technical rally and all of that, and you see a spring and you get in on it, or you get in on the test of the spring, then you're looking for that jump across the creek. Okay? You could be in a very nice trade. And that's why we always say it's minimum objective is to the high of the trading range. But if you're, this is one of the best times to get into a spring at the bottom of a downtrend, because the odds are good you're going to jump, and then you're going to have a nice trade on your hands. So, good question. My previous comment about the first retracement in a new trend is actually point H in the jump across the creek diagram. Yep, yeah, we would call that the first higher high. Well, it doesn't have to be the first higher high. That can be here too. But usually that will occur. So let's look at some examples. This was a recent one in an uptrend. This was back in September, where I'm showing you a little bit about how to use multiple time frames here. Here's the daily chart. We've been moving up, higher highs and higher lows. And then on the hourly or the 45,000 tick chart, we get this little bit of a downtrend move, and it's a fairly swift downtrend, but it gets oversold here. We break the downtrend channel, and then we go into this fairly protracted trading range, right? Now, one thing that will occur often in a trading range like this is that the swings will be wide in the early part of the range, but then they narrow down, right? Don't they? Towards the end. And that's a clue that we're getting down towards the end, okay? And this market did spring here on this time frame, okay? But it necked down into this very tight little range in here. Sometimes we call that the springboard, and we're anticipating that jump across the creek at that point, and that is when it occurred. Now, what I'm going to do is I'm going to take this section here, because this is, say, an hourly chart, and I'm going to bring us down to a 5-minute chart and take a look at what that looks like. So here's where we are. Let's just go back to this. So we're going to look at roughly this section in here. Okay. You can see springboard is like that where it narrows down here. We'll go on the next chart, and here's springboard where it narrows down. Okay. So what happens, it comes out of that coiled position in here, and it jumps the creek. and we see a sign of strength occur. The waves get bigger. I'm starting to get you familiar with the wave idea. Right? The spreads are wider, ease of movement, everything's closing on the highs, no real down, here's a little down bar, but not anything to write home about. And the volume comes in. It's strong volume, bigger than any upwave volume that we've seen in a while. If we go back here, right? Then look at what happens. We get this little backup, and it's a spring. It's a spring on top of the creek. Oh, I love it. Can't get too much better than that. Why is this so good, and why did this take off like this? Because if we look back here, we had all this time in here for accumulation to occur, for traders to get long and build an inventory, and buy in down in here, and now they want to sell out once it pushes up above here. Okay, and that's why we get such a big push out like that. And so here's the jump here, but notice this is also the level of creek up here, and this is also a jump across the creek at this point. And we come back and test that. And you would see that on the smaller time frame. You'd have the back up to the edge of the creek here as well, just like you do here. Okay? So this is structure. This is all about market structure. It's looking at supply areas. Sometimes there are a lot, sometimes it's just one, and it's looking for signs of strength that jump across that supply, and then coming back to test it. Okay? So these other areas in here are just continuation trades where the pullbacks are on narrow spreads and light volume, and you can take trades in here if you like. I'm not going to talk too much about those. Here's a target, I think is what this is, daily chart of stock. And you can see we're in a trading range in here, and we spring at A, and it's a tough one to take. It's in the middle of a trading range, but we get a nice response out of it. And notice what happens here. We would expect this resistance to hold, right? But it doesn't. It rallies through, so we know that that spring is strong. And then we jump across the creek here, all this supply in here. That's the supply area. It's jumped. And then we come back up to the edge of the creek. We have a little ABC in here. Right? We push up. We kind of go sideways for a bit. We spring in here. At F, we have another jump across the creek. You see that? Because this is supply in here, causing that resistance to occur. And the jumps always occur on good spread, good strong move, good volume. Good spread, good strong move, good volume. Okay? And then we have another back up to the edge of the creek here. No spring this time, but notice that the volume dries up just as it did over here. Okay? Any questions on that? Here's sort of a simple one. I know it's getting late. We're almost done here. We get oversold down here, or at least break the downtrend line. And then it's a simple one. We have a spring in here. The jump occurs right in here, and it comes in on good spread, good volume. Kind of gets a little chopped up in here, but it continues to go higher. We have an ABC pullback. That also is a spring. and we drive higher from there, and we move on up, and we expect, you know, higher prices from there. So we get the jump, the backup, and the spring. You see how these start to play together? They don't always work out like this, of course, but that's what we want to see. If we see that, then we know it, and we got that pattern. Ivan says, in general, this is a good spread. This is a good spread volume, strong breakout of resistance, and low volume, narrow spread pullbacks are the criteria of this trade setup. Yeah, in general they are. In general, that's right. We're looking for that strong, the sign of strength. The jump across the creek, here's the creek. This one's in an uptrend. And we have a spring, but it doesn't go, it just only goes to the top, and then it comes back down, and we have a test. It's not a spring. It does spring this level. It tests the spring here. Then we see good sign of strength. This is the jump in here. The jump across the creek. This is on a 5-minute chart. We get good strong move up. And you're right, the backup has a spring, volume recedes, and then we move on up from there. And we've had plenty of opportunity to develop an accumulation area right in here. And that's why this thing takes off so much. All right, fall through the ice is sort of the reverse of that. We have a high that's put in, preferably climactic action. We go into a sideways trading range. I put this in. This is more rare than it. We'll see him an upthrust in here. This would be what's called upthrust after distribution. It doesn't happen all that much. I think I have 1 or 2 examples in here. So you may not see an upthrust in here beforehand, but what you will see is, for the story here, we will have the Boy Scout is now walking. It's now winter time, and he's here, and his campsite is over here. His cabin is over here. And he's got to get across the river, but it's winter, so it's frozen. And he's walking along, and he's doing well because this is nice and thick ice over here, this river that he's walking on. It's nice and solid. It's giving him lots and lots of support. But he gets to here, and the ice thins out, and he falls through. And of course, the river has got a current, and it's pushing downstream. And he floats downstream, and the ice gets thicker again over here. And he's trying desperately to get himself back up above the ice so that he can breathe, but he bumps his head on the ice. He can't get back to the hole that he fell through because the current, and he's bumped his head on the ice, knocks himself out, and eventually drowns. And the market goes down. Okay, so you'll never forget that story, as I always say, right? The idea here is that we've got a story of support that's very strong until it breaks down, and once it breaks down, it becomes strong again. Okay? So the sign of weakness now, or the fall through the ice, is going to occur at C, and then we have a backup to the, bumping the head on the ice, and that's up here at D, and that's where we want to take a trade. Okay, so we can see here, this is the euro currency, a nice uptrend that we have, and it gets a little parabolic up here on this last rally up. We go into that protracted trading range. We actually have a spring here, but we don't get much out of it. It doesn't push up beyond the highs here. And we do have an upthrust after distribution. And after that upthrust occurs, look at how nicely this comes down. This is the sign of weakness. This is the fall through the ice right here. And then we come back up, and we bump our head on the ice, and it looks like difficult to trade, but if you put in a trend channel here, you see that we are overbought at that point. And that's the place to look for an opportunity to go short. And then we go down from there and make new lows. And of course, we're looking for new lows on this. Here is the flash crash day here, right? May 6th back here. And this is that area that we went through, that distribution area here. And we did have a small upthrust. That's where David went short. And we had this big rocking move down. And then look at what happens. We fall through the ice and then come back up. And here's a beautiful place to trade. And look at that move. That was nice. Okay. Here's another example on the Swiss franc on the weekly chart. Clearly overbought in this trend channel, a buying climax if ever there was one. Parabolic, straight up. We don't have the volume on here, but certainly you can see it. And then we go into a trading range here. We get that upthrust, fall through the ice, that sign of weakness, and then we rally back up, and there's the spot to take the trade. Okay. Here's one that's not so clear cut. It's on the S&Ps. We have shortening of the thrust in here rather than climactic action. We have a big wave down. We do have the upthrust in here, test of the upthrust. We come down, but we kind of go sideways in here, form a new ice level, if you will, upthrust this, then break down through it, and we back our head up here. And then it goes down from there. So the principles will show up in different ways, but they always are the same principle. The principles don't change. It's just like it's like the different cultures that we have. We might speak Chinese, or we might speak Arabic, or we might speak French. Or we might speak English. And they're all different languages, but they all say about the same thing when you listen to people, All right, here's something I want to show you that is very useful to understand. This is a weekly chart of the S&Ps, and this is a weekly chart of the S&Ps. This is 2000, and this is 2007 in here, 2007. So we have this uptrend, and we go sideways. We have the upthrust here after some distribution. We have a break through the ice. Took a while to get down there, but it broke the ice and came back up and had the bump against the head, and then bang, it comes down. Okay, and this September 11th was in here, well before 9/11. Okay. This was the most recent bear market where we ended with an upthrust. We ended the high of the market with an upthrust. We came down through the ice. We fell through the ice here. And then we came back up, bumped our head on the ice, and had another. This is a weekly chart, so if you look on a daily upthrust here, a test of that upthrust, and then bang down through. Same thing here. We're bumping our head up against that ice as well. So these are the two big bear markets in our recent history. And you can see that we have initial distribution in here and in here, and secondary distribution in here and in here. So useful pattern to understand. They just look similar. They sure do. So the basic criteria for these the downtrend in a jump across the creek is over, or we're in an uptrend and we're holding pretty well in a sideways action. There's a lengthy sideways action or a trading range. It goes on for a while. It's not just a day or two. Unless we're trading on a 5-minute chart, then maybe it is. But on the time frame of interest, we're going to see a lengthy trading range. And we're going to leave that trading range by driving up and through the highs of the trading range. This is the jump itself, and this is a sign of strength. And we're going to see good spreads, firm closes, good volume coming in on that drive up. And then we want to see price pull back to the edge of that creek on light volume. Lots of times it'll be an ABC. Sometimes we get the nice springs that occur. But the general principle is a light volume, no supply type of pullback. And on the fall through the ice, we're either in a downtrend or the uptrend is clearly over. And we don't even need to know that the downtrends or the uptrends are over when we see these, because we get that strong sign of strength or that strong sign of weakness on the jump across or the fall through the ice. We know for sure that the supply demand characteristics have changed. But just like the jump across the creek, we should see a good lengthy trading range to allow traders to get short, large traders to get short, to build a short position. We see that sign of weakness, that fall through the ice, a drive down through supports, and then it pulls back up towards supports on low volume. All right, any questions on those? Type them in now, and I'll just kind of review what we did here. We have talked about 4 key setups, and as I've shown you on numerous examples, they occur over and over and over again in the markets, especially upthrusts and springs. And really they are defined by market structure. And they do define market structure. They are both defined by structure and they help define it. So they're very important from that perspective. And in my judgment, they are the backbone of Wyckoff trading. They are the bread and butter trades. And I would encourage you to look through the charts on the markets you trade, on the time frames that you trade. Go up a time frame and look as well, and just look for examples and start to study these and start to get a good sense about them, a good handle on them. And you'll see that they occur a lot. And of course, we've got a bunch of different resources. You guys probably know all this. The VSA Club, the wyckoff.org site that we're putting together, and certainly my site at tradingpsychologyedge.com. All right, good. There's some questions. Let me do those. What would you say the technical pattern for upthrust would be? Breaking above resistance, closes on the low, volume requirements, etc. Well, you want to see some weakness in the background. And I'm going to show you applications of these on Sunday when we meet on the second half, and we'll see more. But that Japanese yen upthrust is a very good example, where we see supply, a story of supply and a story of weak demand. And when we see that, all we're looking for is a significant high, a nearby significant high that we push up above and then fail to continue to go higher, and we close back underneath. And so volume doesn't make much difference. It can be low volume, and that means that there's no demand up there, or it can be high volume, and that means that there was some demand, but selling has overcome it. Either way, it doesn't really matter. And in some of these, I didn't even put volume on, as you saw, I think. It's less important. The volume is more important in the actions preceding the upthrust. It's not that important on the upthrust itself. It's all gonna be set up in advance, and the upthrust is just sort of the icing on the cake, if you will. So hopefully that helps. How's the dog? The Asta's doing fine. He's chased away the deer a couple of times tonight. That's his nightly ritual. He stands guard. To one side, what time, U.S. New York, do you run the deep practice sessions? Oh, we do deep practice at 8 o'clock New York time, which is a little late for you guys in Australia, but not too bad. I think you can still do it. And any preference between upthrust and hidden upthrust? No, Brian, they're both good trades. The upthrusts occur. The hidden upthrusts I take only in a downtrend because they happen quickly. And basically, what they are is upthrusts on a smaller time frame. That's the idea behind a hidden upthrust. And so you're just using you're looking into the market, you're looking into the chart, and seeing deeper into the chart on the smaller time frame. So if you're looking at a daily, if your trading time frame is a daily, you're looking into the chart and you might be seeing an hourly chart there. You don't see it obviously, but you're in your mind's eye. You can see it, and you can see the upthrust on the hourly, and that's the hidden upthrust. So that's a nice trade. Eric says, I understand you have 5 trade setups. What's the 5th one? The continuation trades, up and down. It's your morning. That's right, Fiona. It's morning time for you guys. It's like 9 o'clock in the morning over there for you in Australia. Oz, as I guess you call it. How is that new site coming along? Where will you have software scans to search for upthrusts and springs? Yes. Good question, Abdul. Thanks for asking that. We might as well put that up. We're not far away from it. We're trying to launch this in. Oh, damn. We're trying to launch this in February. Okay, good. I didn't lose it. At the New York Traders Expo. And it's richardwyckoff.org. I don't know why suddenly my computer just slowed way down. I'm going to shut this off because I'm afraid I'm going to drop out here. Well, it's richardwyckoff.org, and we expect to have it. We're working on it now. In fact, I talked with them yesterday about it. And we will have scans for upthrusts and springs and jumps across the creek and all the Wyckoff stuff. And we expect the first phase of it to be ready sometime in February of next year. 8 o'clock p.m. New York time. 8 o'clock p.m. New York time is deep practice. Is that my house? No, that's it's a mountain I climbed though one time when I was a little bit younger. That's in Grindelwald, Switzerland. Does the upthrust have to close on the low, or just has to go under the upthrust bar? Just has to go under the high of the past resistance. So let's go back to an upthrust. So we're clear on that. I was looking for one here. So this is the upthrust bar here. This one here. This over here. Okay. So if you're close to the market and you're looking at this, then you want to watch the hourly chart. This is a daily, right? You're trading a weekly upthrust, so it really doesn't matter where you get in, but if you want to be particular about it, you look at the hourly and look for this thing to start sliding down and just go short there. this one happens to be the upthrust here. Okay, so it's closing underneath the previous high. All right, did I get everybody's questions? Any other questions? Can you put together a discount group bundle package for people in this group that want to take additional training from you? We could. We might. Yeah, we could do that. Sure. I'll ask Helen to do that. She's the one who runs all the money. So I'll do that. I'll do that. Well, yeah, we're happy to do that. Yeah, I'm kind of teasing you. I don't mind. We're not here really to we're just trying to show you what we do, what I do on a day-to-day basis. You know, we're not out selling software or anything else like that. It's just how to trade. All right. You make it Helen spends it. No, Helen Helen keeps it all pretty good. Otherwise, I'd spend it. I'd spend it all on us. All right, everybody, I'm going to stop the recording now. And just before I do, just say thanks to everybody who came in. I should have said this in the very beginning. I appreciate, Helen and I both appreciate you all coming in and purchasing this. I know it's expensive and takes time to do this, and you know, there's a lot of stuff out there that's not really worth the money. Hopefully you found this to be worthwhile. We really hope so. We think it is. And you know, send in any feedback, constructive and otherwise. We'd certainly appreciate that. And I will see you Sunday at 4 o'clock. All right, everybody, thanks a lot. Take care now, and have a good week. Bye-bye.